What's up, guys? How's everyone doing this weekend? What's up? Hey. Still poor. Well, I'm sorry. I'm hanging in there. Yeah, I've had a pretty good weekend so far. I got a cat, so that'll be interesting. What? Yeah. Yeah, I did. The cat is currently at the vet. Yellow puts at 41:30 Friday for June. Okay. No, I'm not gonna let chat name it. I think it's a Korot. I went out to the Long Island house and it was just there. Name it J Fresh. Naming your cat Caterpillar? I've thought about it. I did not steal the neighbor's cat. Well, I don't think so. I'm not sure it's not a New York City rat wearing a cat costume. Get two cats, Spy, and SPX. How's everyone's weekend going? Is the cat supposed to help you with your allergens? Oh no, I'm allergic as fuck to it. Name it J-Pow. Well, let's start the day to discuss end of week price movement and future expectations on the SPX. I could do that. Is that what people want to hear? All right, fine. We'll start there. So, um, short call selling remains pretty strong to the upside. Now at the 41.50 through 42.25 level because the older entrenched short calls are still there. They haven't moved. So that like 41.80 through 42.25 level it's been stacked for weeks now, right? That hasn't changed. 41.50, I think we have new short calls. Maybe some at like 41.75 too. I think this is going to provide some upside resistance as, short call sellers move their range lower. That's going to probably create more upside resistance, right? As this kind of rotation continues. Last week we saw a significant amount of capitulation from the short put side, right? Between like 41.50 all the way down to like 40.75. And now, instead of, 41.50, 41.25, 4100 still being stacked, those have fallen off by and large. And now we really just see like 40.75, 40.50, 4,000. So the short put side has weakened The short call side has become emboldened. Um, we do have almost a true rejection here on our last 1 hour candle on Friday. Futures did fall just a bit short of where I would have liked to have seen them by the end of the day. I really would have liked to have seen futures break down through that one standard deviation. They didn't, right into the end of the day. So I would say that we haven't confirmed the breakdown yet. There's still a potential for a bounce. Obviously, the 4150 sold call side is still weak, so it's still building. We may rise above it still, but we do have that strong upside resistance at 4180 and higher. So I would say, depending on positioning, well, futures movement tonight and positioning into tomorrow morning, I think we'll get a better idea of if we're either going to, see like a small bounce into the CPI data, which would probably put us somewhere around like the 4170 level, right? If we were to see the bounce here. Or, we see a continuation of this rejection and we fall lower to like the 4100 level down here where our fast gamma is. And then I think either outcome, we're probably going to stabilize somewhere in that mid-range for CPI and then PPI, right? CPI, some bearish potential. Last report we started to see core move up above headline. I think month over month is still continuing to increase. PPI a little less. I mean, year over year, both of these are probably going to be down. But PPI might be up a little month over month due to the spike in oil last month. So, from end of March through April. So, there is some chance that we see some residual effects on PPI from oil. Those would be more pronounced in the next print for CPI out in July or June rather. So yeah, that cost increase on the producer side will be realized in CPI later. But right now, oil's back down again. And I don't know if we're going to see enough of a effect on headline inflation yet for people to get scared, but we're also only, now a few weeks out from the next Fed decision, right? We also have SLD coming up, not this week, but next week. SLD begins on the 17th. So I think we may see like kind of the usual pattern throughout that period. I think after CPI, PPI, that red hot labor data, we could probably see some degree of downside after those prints into the end of the week, and then maybe, a bounce back a little higher into the SLD period where, then we can see some downside. If we see a large risk off all the way from now into the SLD period, don't expect SLD to give decent returns. Also, there's just been a margin haircut through the DTCC, so leverage may not be that high. This SLD period is going to be a little tricky. Are we expecting anything from Baba still? I mean, Baba did kind of bounce twice. They both sucked. I don't know. I mean, if the market continues to rise, maybe it's got a little potential, but at this point, we're getting pretty close to earnings. Obviously, I have no idea how those are going to turn out. I would say if this fails, it might be a good put opportunity with like a target of 78. But right now it's holding the uptrend, however weak it may be. So really just not a great time to play it, honestly. Yo, what's up, man? Don't forget to drop a like. Yeah, if you guys could, please. Uh, they make hypoallergenic cat food. Over the course of a month, the cat will create less dander, may help your allergies. Oh, okay. Good to know. Do you think DJI is somewhat of a leading indicator with other indices? Or is my bias showing? I mean, it can be if there's like strong sector shift, right? I don't know if we've really seen a lot of that lately. Why do you ask? Quick TA on Meta. Sure. And it looks like it's distributive. It's failing. Maybe fill the move down towards the 200 range. Might take some time though. I probably wouldn't target beyond 220. And then, anything it fills after that's just nice. But yeah, this looks really distributive. I mean, I'm sure there's longs closing given the dilution incoming, right? So 100 BPS moves versus 2 to 300, probably, yeah. I would expect that at least until CPI PPI is resolved, we're probably not going to see like 2 or 300 BPS moves. If we are going to see a big move like that, it'll be tomorrow. So if the call side doesn't, so here's something. The call side on Friday was mostly built on the back of zero DTEs, right? Without a lot of like long-term stability. It was really more truly a pump than our previous bounce. If call interest doesn't come in to sustain the upside move, which it wasn't at the end of the day, then it can very easily collapse to those lower levels where the short puts are at. Because there's really nothing there to support it. Even Friday, had we slipped, significantly under like 4130, we probably would have fallen to like 4110, 4100. We just didn't have really enough time into the end of the day. But the call buying had all but stopped, right? And we were starting to get that sell off on futures when futures tested, that 4160 range right here. And that's also, like our long-term resistance from, Jesus, like back in October. So it's kind of an important one, right? It's this one. If we're failing to the downside of that trend, right, and rejecting off of that's pretty bad. Back here, it took quite a long time for us to build up enough momentum to move above it. A few weeks, right? So I think it's possible that we may fail. We may fail on Monday morning. At this point, what could bring the market back down to 38.39? The market seems ready to deploy liquidity at any moment to keep it up despite future earnings. Well, liquidity is drying up. So, the Fed discount window continues to close. Liquidity is becoming more and more scarce. And the range in which they're able to pump is narrowing, right? It's narrowing a lot. I know it doesn't feel like it when you're staring at the 1 minute chart, but this upwards consolidation, on the technical side, or, if you look at like, liquidity and the flows, there's way less liquidity being brought to bear on these more recent pumps than there was, like say end of March when we first moved up into this range, right? And that's not coming back. All that liquidity that was created during the bank failure period, that's basically gone, right? So there's not you know, the Bulls are kind of out of ammo, and it's their positioning is rapidly deteriorating. So you know, not only the shorter dated like call positioning is weaker, and the futures buying is weaker, but like, you know, their ability to sustain those pumps with margin is weakening, as you know, they've had to capitulate on, you know, large amounts of their like short put positioning that was crediting those pumps, right? And additionally, you know, the margin haircut that they took from DTCC last week means that it's harder for them to do that again, right? So you know, the DTCC kind of stepped in and took a pretty strong stance against, you know, all this like credit fueled zero DTE buying, and you know, haircutting all that margin means that they're not gonna be able to do it to the same extent. Beef Fly, welcome to Dillionaire, man. Thank you so much. Hit me up on the Discord. I'll get you added after the stream, dude.
Happy birthday, girl. Yeah, we might have a chance, but we ain't got rope.
Any relevance to the megaphone that's formed on SPX beginning in April? I mean, the volatility of VIX has picked up. I assume you're referring to this. This isn't really a megaphone. I mean, this part kind of is, but this is, you know, the same bottom. So we're not seeing a greater expansion of volatility. But I mean, yeah, I mean, we are seeing more unstable volatility, right? VIX is getting, you know, VIX moved up like $4 the other day or more. It moved back up above 21 really briefly, right? And then slammed back down again. And you know, megaphones kind of just represent those big shifts. But you know, technical trends on indexes are always going to be like less valid than more in-depth analysis. Do you mind taking a moment to please walk us through your Bitcoin price target and show us how you arrive at 9,000? It's a historic resistance. Also, I don't think my support is at 9,000. Is that where my buy is? I think it's a little lower than that. Hold on. No, it's 9,896. I mean, that's the effective distribution over time, right? Is that, you know, previous buyers become more and more willing to sell at lower and lower prices. But yeah, it's just a support line. There's some solid value dividend plays now. Is that a rotation value to growth? Right before a recession, stagflation. Thoughts? Yeah. I mean, those plays were always there, so I'm not sure what you mean. There've always been solid value dividend plays. And dividends are always shitty, in my opinion. But those have always been there. People just ignored them in favor of growth. But generally, yes, if you're going to hit a recession or stagflation, people will take, you know, higher yields. I doubt you're going to find a lot of dividends that beat treasuries right now. I mean, only in like specific instruments like REITs or close-ended funds. When I'm looking to buy O, That's a good question. Probably not for a while. I probably won't be buying any O for like a year or two. Prior to all these bank failures and the like realization of the liquidity crunch, I was targeting like 55. Um, I'd probably be more likely to short this with a target in the 40s right now than I would be to go long on it at any point anytime soon. So yeah, I don't see a point where I want to go long on this, at least for a couple years. Short it, maybe. What do you mean by distributive when you're talking about meta? Sellers are becoming more and more numerous over time. Which you can see here, right? As the price peaks and then starts to trend down. This is generally, longs. This, up until this point, you have longs, right? And then, sellers are taking over as the trend changes direction significantly over the same time period. And then you see how long those sellers persist, or if those sellers gain momentum as these gains start to slip away from longs, right? So if Meta starts to fall below the earnings pump, everybody who owned Meta here is going to want to sell Meta here, right? This is where fear kicks in. This is kind of like the inception point for that. Well, yeah, because the DTCC doesn't want to be at risk for all those, hold to maturity securities and stuff they're using to prop up their collateral obligations, right? And all that margin from those regional banks. Like they don't DTCC doesn't want to hold the bag, right? And so yeah, the haircut. I mean, the haircut made sense. I'm surprised we actually haven't seen more margin haircuts over the last 6 months because tail risk is getting fat, right? And obviously the DTCC is most exposed to that. Hey Gork, 13F report due the 15th. If they sold off all their shares, won't that show up? Who? Oh, for like major institutions? Yeah. Thanks for your reassuring words in Discord about June puts. Plenty of time to realize profit. I'm going to add to the position after PPI and before SLD, depending on price action. Nice. Can you elaborate on the relationship between the haircut and SLD? I mean, it means that they're going to have to make changes to their margin deposits sooner rather than later, right? And so there may not be as much of a risk off during the SLD period. Very simply, anything that affects margin in the interim period from one SLD to the next can have an effect on the next SLD. Why hasn't RRP been pulled back yet? Because the rates haven't been pulled back. It's part of quantitative tightening, right? Maintaining that high on RRP rate. No way. Did you really get a cat? Yeah. This is on a raw diet. He doesn't stuff my allergies. Yeah, for sure, dude. Definitely. DM me. How do you think a potential short sale ban would affect liquidity? I mean, it's going to create fear, right? If they ban short selling, everyone's going to try to sell. You know, in 2008, I think the SEC banned it for, it was after the crash, first of all. The SEC has already said they're not doing this, regardless of how much steam it picks up on Twitter. But yeah, back in 2008, I think it was for like less than a month. It might have been like 2 or 3 weeks. I think it was like September, like late September through early October, if I remember correctly. It was relatively short. And that was to keep short sellers from continuing to pressure stocks that had already crashed, right? They needed the economy to recover, right? And you know, short selling begets more shorting, right? And fear compounds. And so, you know, when they do that, it's to stop short sellers from driving everything into the ground, right? And embolden long-term investors to come back into the market, and you know, create a safety net for them. Because, you know, otherwise, you know, the short sellers would just try to seller box everything, right? Because greed will always win out in a situation like that. MSTR bankruptcy before 10K Bitcoin, simultaneous events. Have you heard about our Lord and Savior Jeppy? Oh Jesus, isn't that? I feel like that's only worth buying if VIX is high or VIX is low. You want to buy it? I think you want to buy it when VIX is low. Thanks for everything, Gerg. Also, name your cat Cat Lady. I don't think it's a lady. So, I mean, that's up to the cat. Thoughts on NVIDIA going into next week? Would you sell bear call spreads at this price? You have a pretty long conversation in Pickles Picks with responsible investor on my like current strategy surrounding NVIDIA. I suggest you check that out, and then tag me if you have any other questions. What are the banks going to need to do to get out of the low interest MBS in the face of interest rate risk? I mean, they need the Fed to pivot. They need the Fed to pivot really, really bad. If the Fed keeps tacking on even these small incremental interest rate increases, you know, you look over the course of this year and we've got another 75 BPS hike, right? So, you know, even though they're more drawn out now, the same risk is being created, right? And yeah, I mean, in order to dodge the inevitable bullet of MBS liquidity, an MBS liquidity crisis, I mean, they need the housing market to remain stable, which it so far mostly has, right? House prices really haven't fallen very significantly, but when they do, that's going to be a big problem because those are collateralized loans, right? Now don't get me wrong, house prices will fall, right? And the ratings agencies won't do anything about it until like 6 months into the fall of house prices. And then they'll be like, oh man, these these MBS are no longer like AAA tranches, right? And they're going to start to like, at some point, they're going to have to downgrade them, right? Which kind of gets into like what happened with like the Big Short. But don't expect anything in that sector to move really fast. Like they'll defend that to as long as they can at least. But if the Fed keeps rates persistently high, I mean it's an inevitable outcome. that housing prices will have to drop, and like collateralization of those loans is going to fall off a cliff. Also, defaults are already rising, so that only makes it worse because that brings more liquidity to bear. And a more liquid market means cheaper home prices. That's an oil natural gas this week. I didn't put down the cat. What the fuck? Is natural gas in a buy range? Why? Why can't natural gas just stay cheap as fuck for the next 10 years? If you can give me a case that says it can't, then I might buy some. Yeah, I think the idea behind the oil short, or at least as I see it, is that they don't want that inflationary pressure, right? Because higher inflation pressure means more action from the Fed. So I think the big banks, floating rate interest, uh, risk carriers, would benefit from shorting oil, and that was my thesis before oil fell off like a couple weeks ago or last week. Well, end of last week into this week. Oil's bouncing back. I think shorts on oil are going to be skittish, very skittish, because if you short it too much, OPEC's going to come in with more oil cuts, right? And not to mention, there's already a buyer at the bottom as the U.S. fills back up its strategic oil reserves. So, and don't get me, I'm not like a big oil macro guy, but this is just kind of stuff that makes sense. So there's already a buyer to the downside. So you're kind of capped on the range down that you can short oil. And then if you get oil to those prices, OPEC's going to want to pump the rates again, right? And then, they're going to flex and pull back even more production in order to get those oil prices back to where they want them and, maintain control of oil market pricing. Now, they can only do that so much, but it's a huge risk if you're going short oil. So it's a dangerous game. The fact that we've seen some of that play out, I think helps just add additional confirmation to our theory, because that would be like the next inevitable step, right? If you're trying to maintain this really, strict market range, is that you need to go attack oil, because that's the thing that presents the most risk to the Fed, right? Is that headline inflation pricing. So you want to attack inflation at its source. Which, I think has already been successful with nat gas, given how low it is. Now, a cold winter, that could fuck all of that up. What do you think about movement this week on illiquid stocks like GME and Upstart? I think a lot of market drag is responsible for price action that we saw on both GME and Upstart. We did see some liquidity resolution into the end of last week on GME, obviously, but not a big shift in trend, right? I mean, liquidity is still basically flat. So there's not a lot of covering going on here. We did get that bump from ETF FTDs and the market rising simultaneously for a couple days, which is nice when it happens. The fact is, though, that nowadays we need both to occur for any real upside, which kind of sucks. But we have more ETF FTDs this week. I think if we see continued active fund pressure, then some more price improvement is available there. But then the reverse is also true. If the market falls, they'll offload the internalization and short and then dump the price, right? So as fast as it can go up, 3, 4, or 5% in a day, it can also go down 12% in a day. Upstart, on the other hand, is looking a little more bullish as it approaches its earnings this Tuesday. Part of the liquidity, here's my problem with this though. Part of the liquidity realization that we've seen here, right? That, illiquid, more liquid, right, as it trends down. And then, secondary markets. Um, the a big part of this liquidity was selling, right? Um, like actual selling, like volumetric sell off, long holder. I don't know who. Somebody with a lot of shares of Upstart sold, right? Or several people with a lot of shares of Upstart sold off. Um, if that liquidity realization continues and it's continued to be buoyed by the market and the FTDs and the MMFTDs, then it may start to accelerate and kind of turn the other way and turn into, covering liquidity, which would be, very bullish, obviously. But with earnings right there, I feel like that's going to be the deciding factor anyway, right? If Upstart manages to pull out another beat on another quarter in another in an increasingly worse credit environment, I feel like that's really bullish for the company long term, right? Like the fact that they did so well on earnings last time was awesome, right? I mean, I don't think there's any denying that, they are trying as a company. It's not like they've, given up or the executives are jumping ship or anything. They're very undervalued, but they're cash rich. They've got decent cash flows. They're not going out of business anytime soon. And the executive team seems committed to expanding their business as much as they can in this illiquid credit environment, which means that when the credit environment does stabilize, it's that much more bullish, right? Because they'll have all that additional underwriting exposure. So I think the long term case is still really good. Um, Obviously the prices are really cheap. $12 to $13 I think is still like our historic low range, unless the Fed moves forward with steeper rate hikes or a plan of continuation in rate hikes. Then people aren't going to get too spooked out of their positioning. For the most part, some people will, but yeah, I think another good earnings here could kind of turn this slow liquidity realization into something faster. And there's some range on it, right? I mean, these are the points at which Upstart is most liquid, and those both represented, even this right here, represented pretty significant runs in the price of Upstart. So um, it's got some potential, but be wary, right? It is an earnings, and it's kind of an interim period. If potential is realized at earnings, it may have like kind of a spicy opex. It is a band-aid on my pinky. I cut myself on a cat carrier. Thoughts on Dole? Chance for it to go under 10 in the next 6 months. I don't know. I'd love that. If the market crashes, I'm gonna buy more of it. But since it was a pickles pick, it's fucking done nothing but rocket, right? So and this is on the weekly. Even worse, right? Um, but yeah, it's almost had no drawback, and this is the biggest drawback that it had in this entire period. Hopefully, yeah, I mean, we see some stabilization in food prices, or the market crashes, and then maybe we get it back in that buy range again. Uh, under tens not as hard. But yeah, I don't really want to buy it at 10. I don't have that high of an upside projection for it over the next couple of years, and I don't want to own it for like 10 years. Well, at least not right now. There's indexes that measure tail risk in the market. Like, there's an S&P 500. Okay. There's a tail risk index. Bull whips. Nice. Where was I? Is it okay to ask for feedback on potential trades? What do you think of Uber through the at least? I mean, sure, but I can't answer questions on all of your potential trades. I don't have time. Um, yeah, Uber looks pretty overbought right now. Uh, 32? Maybe. Make sure you get some theta. Yeah, I mean, I don't think it's out of the question. I don't think it's the best play. Your range is kind of awful for options, but I don't think the price target's too far out there. I mean, mine would be a little higher. I'd probably target like 33. But yeah, I mean, 32 is possible. Explain cat, please. Also, could you dive more into Jeppy at low VIX? So Jeppy pays out its dividend based on the premium received for covered call selling, right? If you buy in when VIX is low, then when VIX goes up, you should make arguably better returns. Is it okay to add BTU and HAL at these prices? I'd like to DCA. I don't think they're in a bad spot. BTU's quite cheap right now. I mean, there hasn't been an opportunity to get it this cheap in quite some time. I mean, since like October. It's almost lower than it was in October, actually. Halliburton. Hold on, I haven't looked at Halliburton this week, so I gotta take a look. I do like BTU in this price. I have a bunch of like cover calls out on it and stuff. Halliburton, you might want to wait a little. This could be like a local bottom, but if we see more downside on oil, there may be some opportunities to get it around like 26, like this lower end range here. Or a like decent market downturn could see it fall to those levels too. I have covered calls out right now on Halliburton at 20, no, 30, 30, I believe. It's not great for covered calls, but they do help improve yields. I mean, technically, a short sale restriction wouldn't stop short selling. It would just make it inaccessible to the general public. Thoughts on Oxy? I mean, I own a bunch of it. I like it. I think they have good crude exposure, and their expansion in the Permian Basin means that, if production demand goes up, they should do very well. And Buffett definitely did his research on it. If you can buy it cheaper than Buffett, you're probably winning. What are your thoughts on Dixie not really moving much with the rate hike and news of further hikes? Is it showing is this showing a lack of confidence from Forex? Possibly, yeah. I mean, oil's still kind of down. The rate hike wasn't substantial. And then, it was followed by more bank fears. So also gold has been up, which tends to pull back on the dollar a bit. I think the cat's name should be Caterpillar after the one true stock. And then you can call them cat and have to explain to people that it's named Caterpillar. I see. I don't want to do that. Have you looked at the Cleveland Fed CPI forecast? It looks like they're expecting a hot print. Yep. I have, and it does, and they are usually pretty correct. They definitely are a little bit better than analysts in that regard. Their expectations have been mostly in line and accurate. Sometimes there's a slight miss, but GME has not been confirmed to be added to the Russell 2K yet, but it could increase liquidity. If GME were re-added to the Russell 2000, it would be heavily weighted, right? One of the most heavily weighted, if not the most heavily weighted stock in the Russell 2000, which means that it now, or it once again would have significantly higher amounts of active fund exposure. And that would, obviously generate lots more volume. And as we all know, volume creates obligations and failures, which then, create more volume. So it's, I would be very excited to see it back in the Russell 2K. I think that was a big part of the price action that we saw occur with GME back in 2021 was due to that. And so yeah, a re-edition would be, especially with the liquidity the way it is now, would be phenomenal. If I want to own Upstart stock, do you think buying some before earnings is still fine? Sure, but obviously, you know, uh, try not to buy anything ever all at once, right? Um, I see people still continue to do that after all this time, and options or stock or whatever. Take your time moving into positions, especially if they're longer term holds. Behind on the stream, but the new margin haircut doc was line by line identical except for the exclusion of Comerica. If I'm remembering correctly, didn't I miss something? I don't remember. I also don't know what the fuck you're referring to. There's totally no context in any of that question. How's Palantir looking? It's still like a bag of shit for the next 5 years, but it's there. I'll buy more of it at like 650 or lower. I think my covered calls that I have out on it right now are gonna probably expire worthless. They don't have earnings for Oh, they have earnings tomorrow. Earnings are tomorrow. I don't know how good earnings will be. They might beat again, but expectations are raised because they improved guidance. Could you share potential picks to buy puts on with high CMBS exposure? No, because people here have a hard enough time maintaining a short for an entire day, let alone maintaining one over 9 to 12 months. Have you been playing with your kitty? Not yet. Can you talk about selling a calendar spread on NVIDIA when it pressures GN? Are you selling short dated put to cover your long? Yep, pretty much. Yeah, so when it's I don't have a lot of put positions near the money on NVIDIA, but I do have some like 270, 265, 260. And I use those to hedge calendar spreads. So I I'll sell like 265, 260, 255 puts for shorter expirations when it tests or falls below gamma neutral. And then a similar thing to the upside, right? I'm selling bear spreads like at the money and just out of the money when uh like longs start to pile into the short calls at the top of its range. I think June 13 is going to be a big day with the CPI release, one day before FOMC rate hike announcement. Last time that happened, there were big moves. Probably, yeah. Definitely a lot of volatility, right? Because, one position is going to have to move around and reposition going into the next one. So usually those days, like when you have big economic events that close to each other, you get tons and tons of volatility, both up and down though, right? Because everyone's like trying to get into position for the next event. Do you expect Fubo to continue up? I mean, I really liked how their earnings looked. They're clawing back that negative EBITDA. It looks like they're well on track to their goals, and they don't need supposedly don't need any additional capitalization. So, not only may that improve my target price going forward, but they may meet their goals of profitability early. I think Fubo becomes a significantly better buyout target the closer they get to that profitability threshold. Right. I mean, obviously, anybody wanting to buy them out is going to want to buy them out before they become profitable, not afterwards, because afterwards, then it's are they going to sell, right? But yeah, I mean, I think management is on track. I mean, I've bought more. I've been buying more. I took some profits on some of the $1 synthetic longs that I was in from when we fell under $1. Over the next couple days, I kind of want to see what's going to happen with it. But if the market shows some more signs of pressure, or QQQ does, we may get some more realization of liquidity on it. There's still quite a lot of liquidity that can be realized on it. Earnings didn't create that much of a move yet. I know it's up 30%, but as far as liquidity is concerned, you can see how far it moved in August when there was actual covering, right? Even here, we had significantly more upside during that like defer pex period at the beginning of the year, right? So I think more liquidity can be realized on this. And yeah, so I'm gonna wait to take profit on like the $1.50 and $2 synthetic longs I have out. But yeah, it looks good. I mean, and all around, they're doing what I expected them to do. You know, last year when I first started buying in. And as long as the company continues to perform as expected, I'm not worried about my long position in it. When you say buy theta, do you mean 60, 90, 30, 45? Does it change in context? I feel like it can, yeah. I would say I would probably for Uber, I would probably want at least 45. You remember under 30 and you're hitting the faster rate of decay, right? So you have like 30 to 60 decays slower, 60 to 90 it's really slow. Under 30, you're gonna hit decay rapidly. And so if it's gonna take some time for the price to fall into your target range and you're buying out of the money puts, make sure you have enough additional padding on your theta to cover that period before you hit a period of more rapid theta decay, right? So if you think it's going to take like 2 weeks for the price to fall to your price target, look at like 45 DTE. If you think it's going to take a month, look at 60. If you think it's going to take, a couple months, start looking at like 90, right? I feel like it's not that complicated, but I understand that if you're new to this, it can be weird. You want enough theta at a low rate of decay to cover your exposure period while you're waiting to hit your price target. The period that you're going to be out of the money. Can you make a case for why a crash is not on the table? I mean, there's a possibility that the needle gets threaded, right? Like, the banks are able to, scrape by long enough and, exposure to the up and downside remains limited enough till we start to see a change in employment and inflation, a substantial move in both unemployment up, inflation down, and the Fed decides to begin clawing back rates. My biggest problem with that is I think it's too long. I already think that the pressure is on. The range in which the market is trading is consolidating rapidly as these new rate increases come in, and the floating rate risk and the Treasury risk aren't going anywhere, right? So something will probably break before then, especially if the Fed is willing or insists on holding the current federal funds rate into the end of the year. So I think the only thing that saves them is the rates actually getting pulled back. But they could do it, potentially. I mean, there is a case that they nail it. They thread the needle. Treasury risk doesn't increase and yield risk doesn't increase. They're able to balance it, and market gets progressively more flat. And then we see a drastic shift in inflation at some point, and the Fed decides to pull back rates. And once the Fed starts pulling back rates, the banks start to get some breathing room. But that has to happen before real estate starts to devalue, right? Because that breathing room is going to get eaten up immediately by liquidity coming to bear in both the commercial and residential real estate markets. So I think there's a very slim chance, but you have to take into account that chance exists, and they are going to try for it. I just don't think they'll be successful unless JPOW starts working with them, which so far he hasn't. Do you think that CPI PBL will determine the market direction until June 13th? Or just likely to see more range-bound chop until then? Why June 13th? I mean, it'll influence some market direction, but so will SLD, so will OPEX, so will the pre-SLD and post-SLD periods that come in between there. You have another CPI print by then, right? Or right then. Future Whale 747, welcome to Dillionaire, man. Thank you so much. Hit me up on the Discord. I'll get you added to the country club after the stream, man. On a controlled downside move, should use a bear credit spread in lieu of a put, and use a put when the downside is large. Is there times when I should choose one over the other? I mean, they both give you the same exposure. One's just risk limited, right? And the other is, your risk is your premium spent. So that's a risk decision, right? How much risk you want to take. Obviously your profits are capped on the credit spread to the credit received. And your profits are, on an index, nigh unlimited, basically, in both directions. What treasuries do you like right now? I don't know. I haven't been buying any recently. I'm kind of waiting for the 2-year to move up a little more. Maybe the 5. I don't want anything longer than that. Do you think UVXY is a good buy right now? Stocks and long dated options. I don't really like UVXY. Maybe after they split again, but right now it's like what, $3? And the VIX would have to go up for days and days and days on end for it to even hit like 10. You just want to buy it because it's cheap, Javi. No problem, Flocala. Doesn't pulling back rates trigger a recession? Yeah. I didn't say it was going to be easy for them to thread the needle. I think that the recession in this case is definitely inevitable. I think at this point we're just determining how long it's going to be. If the Fed is more aggressive, we might get a shorter recession. If the Fed remains slow and weak in the face of rising inflation, we're going to get a very, very long recession. If we do get that sustained call interest Monday, would you consider bear call spreads around 4180, 4200 for end of the week? I mean, I've been selling some SPX spreads in that range anyway because it's so well defended by everyone else. I might as well get some free money too. But yeah, I mean, always when selling spreads on SPX, be careful and try to limit your risk. They can get blown out very fast, as we saw last Friday. But yeah, I've been taking advantage of all the other call sellers in that range. I mean, it might as well. Obviously, it does make calls cheap, so it's not the best profitability, but I've sold them. You can get some decent premium returns. All right, let me see if Dork and JFresh are hanging out. What's up, nerds?
What's going on?
How you doing?
Doing all right.
What's this about a cat?
I got a cat.
You got a cat?
Yeah.
Oh man, me a roommate?
Huh?
You got me a roommate?
Yeah. I had an extra shoe for someone to shit in, so I figured why not.
What's her name?
It's a him.
Ugh.
I haven't. It doesn't have a name yet.
Well,
I'll think of a good one.
I've got one idea.
I was gonna call him Little Meatball, but I'm still considering things.
Your name is Walking.
Oh god.
No, I can't live with that.
So what's there to talk about before we all get all crazed up about all the Binance stuff? Binance reopened BTC trading. Crisis averted.
Oh, damn.
I know. I was so disappointed.
I didn't actually care either way. But
yeah, I was just excited that there could have been something going on, but apparently it's just I guess they've started allowing people to make tokens. So now you can, if anybody still cares, you can now make like NFTs and shit tokens on Bitcoin. I didn't know that Pepe coin was actually on the Bitcoin blockchain, but that's what's going on. People are just minting so many shit coins that the fees have skyrocketed. and Binance didn't want to pay them, so it just stopped for a while.
That's amazing.
Yeah,
I hope they go out of
Get your-
business.
get your Pepe coins now before they're gone.
I'm already full ported, bro.
Oh, Jesus Christ. Well,
Well-
I don't know. I mean, you guys
Kinda same
can
as
get
it
the
ever
ball
was.
rolling. I've been running my mouth for like 2 hours already.
Yeah.
Or
What
an
you
hour.
got, Dork?
What do I got?
Hold on, wait. I always want to say this and I always forget. What you got for me, Dork?
That's my fucking line.
I was gone all last week. Still managed to make a little bit of money, which I was happy about. I mean, last week seemed super duper interesting in the entire.
Thanks for printing my puts, by the way. Go with your
Yeah,
vacation.
no problem, everybody.
Yeah.
Hey, everybody, yeah, just feel free to say thank you. You know, make sure you appreciate what I did by going away and not being able to make more money than I did. But yeah, it was still a nice time. Like I said, I made a little bit of money, so it was like I wasn't too bummed. Better
Now-
than
Now, if you
Right over.
died on vacation, we never would have bounced. We would have just kept going down. So, next time, just think about like riskier vacation options. You know, like
Okay, so
can you
like,
get if you can't get lost in the wilderness for like 2 weeks?
I was
is
thinking
it worth
like
taking?
next time Venezuela or Bolivia.
Ooh, what about Somalia?
Ooh, there we go.
Yeah, the
That'd be
State
good.
Department really doesn't like Americans going there.
There or the DRC.
Yeah, and then if you get kidnapped, the market can crash. And then
Yeah.
and then we'll have enough money to save you.
Just go all in. Go straight to North Korea, man.
You know, and steal a poster.
Yeah, or spray paint like a mustache on one.
But yeah,
There's literally nothing more dangerous you could do in the entire world.
That's true. Well, yeah, that's true. So yeah,
You could try to run
crazy.
through the demilitarized zone. Naked.
Ooh.
Streak.
Yeah.
Yes,
Yeah.
you have to streak. That would be epic.
I have to do it with the South Korean flag, like pinned around my neck, like a cape.
Like a cape,
Like
yeah.
North Korea.
Wait
With,
until because they all blast music into the zone, right? To like, for some reason, they're like actually just blaring music at
What's
each
up,
other.
Han? Thank you.
So you have to wait till like, I don't know, some like epic song comes on, then you just make a run for it and see how far you get.
Big Mac in each hand.
Yeah,
Oh,
I like it.
If you do it with an American flag, do you get shot by both sides?
maybe.
All right.
South
The
Korea
Canadian
likes us though. Wasn't the guy from South Korea just here singing what's the song about driving the Chevy American Pie? Anyway.
What a good song. But anyways, back to stuff that makes us money. So last week was crazy interesting, wasn't it?
It was. Yeah.
Yields went nuts on Thursday and Friday. I was
Mhm.
watching them on CNBC. Like every time they'd pop up, they'd be at a different number. I was like, "What the hell's going on?"
Yeah, yeah. Also,
I
we
have a
saw
theory.
more of that duration risk hedging coming in with those. I think based on what Buffett said, Burke went pretty balls deep in the 1 month. They're trying to get those treasuries before the shutdown cut off. Don't forget, guys, government broke in 3 weeks.
Yeah, well, that's why the bonds are going nuts, right? I mean, everybody was like, I mean, you remember just a few weeks ago, the 1 month was at like 3.5 or something ridiculous. It was like super low,
Yeah.
and people just didn't want to touch it. No, sorry, people wanted those because they wanted to avoid the X date, which was expected to be somewhere around late July or August, right? And so they were all piling into the 1 months and avoiding the 3 month, and then Janet Yellen comes out just like, your 1 months are fucked.
Yeah.
And everyone just like, God damn it. And they all sold their 1 months. And so now those went up 20%.
Yeah,
they haven't, it doesn't seem like they really jumped into a lot of, I mean, the 3 month does look like the rates were more suppressed than the other timelines. But I mean, at that point, you're playing with fire. So people are just dancing around trying to figure out when the X date is. Because money markets, they don't want to get stuck with a bond that doesn't pay out on time, because then their liquidity gets
Here's my other
gets
question.
scary.
Why is the Treasury General account going back down? Like, it's tax season. Treasury General account should be rocketing up.
They just got a little baby bump on taxes.
I think Yellen's
all.
gonna go broke sooner than she told people.
That would be interesting.
I think no one's paying their fucking taxes this year at all. Everyone's gonna defer, and the Treasury's gonna run out of money early. I mean,
How do you defer?
How do you defer? You don't know how to defer your taxes? You just don't.
I don't know.
Just be rich. Hire a lawyer.
Oh, I just pay my taxes. I don't
Oh.
know. We usually get money back. We're those weirdos that are.
I mean,
like,
I don't have
not
enough
trying
money
to-
for it to be worth it. But if you have like millions and millions and millions of dollars, it's worth it to like just not pay shit for 5 years. Get whatever money you can off having that additional capital for that period of time, and then pay them all
and
at
like pay the
once.
fees.
Yeah.
Nice.
Once you get rich enough, your patriotic duty shifts from paying taxes to deferring your taxes.
To creating jobs and trickling down.
Yeah.
Exactly.
Well, I mean, if you're not trickling down, what are you doing?
Exactly. Can't wait to be a trickler of myself.
Yes, Mr. Poopy Pants. I am giving the government interest-free loans because I am. What's the term? I'm burned out on decision making. Sometimes you just gotta let some decisions go. My life is not perfectly optimized.
You do actually have plenty of time to file your taxes though. There's you could do it you can offset them for quite some time without paying any fees.
Yeah, but I set them because I usually get money back, so I just do them in like February.
Well, don't make it a selfless thing.
It's not selfless. Just lazy. It's just one of the things I don't prioritize.
The only
Anyway,
reason I deal with taxes is so I don't go to jail. But even then, I had to
Dude.
deal with a Fubo CC that I sold, and the cost basis on it was 0. And TurboTax was like, "Hey, what was your cost basis on this?" I was like, "I don't know what I bought it for, I guess." And I hope I don't go to jail over like a
Dork,
$4 profit.
Dork, I've seen your car. You're never gonna go to jail for tax evasion.
Yeah, they literally don't care. Was it even over $10? They don't even care. Like, I don't even like all my checking accounts and stuff. They get like 0.01% interest. Like, I don't even report those because they don't care.
Well, yeah, I'm not too worried about my one Fubo CC.
You should not be worried at all, dude.
But man, oh man, this Friday was weird. There's a big giant downside gap on SPX now.
Yeah.
Really,
I mean, was it
tasty.
that weird though? I mean, I think we've seen this play out over and over and over and over and over again. I mean, it's literally
Except I feel like the Bulls were pushing for like 4150, 4180, and they got 4136 by the end of the day, and they'd given up. We've never seen them just give up into
That's
the end
true.
of the day before. They're really hurting for that like liquidity to keep this train rolling. And I think
something popped at like 2 or 3 o'clock that day, 2 or 3 o'clock. I can't remember what it was. There was some news thing that I was like, oh, maybe that's why it dropped.
I don't think so. I think they just got. I mean, they kept buying calls, and the price just kept falling. I was watching like the volume and gamma come in, and like there's just like the 4150 sellers were coming in strong as fuck. Which
I
is,
saw that.
and that doesn't look good to the upside going into tomorrow at all. I think they're just getting like it's just a slow position shift, and the Bulls are just getting crushed out, and their downside support is obliterated after the 300 BPS drop earlier in the week, right? Like they lost all of their short puts at like 41.50. They lost the short puts at 41.25, 4100, 40.80, 40.90. Those are gone, right? There was so much stability at those levels, and now it's not there. Now all they have are like their short puts at 40.75, 40.50, and 4,000, and they're afraid to sell short puts nearer the money because they don't have any traction on the call side. There's no long call interest coming in alongside them for that
Yeah,
additional
I
support.
definitely, I feel like the composition of men is definitely selling a lot of short puts right now. But I feel more comfortable selling calls right now than puts.
Yeah.
I agree. I see so much violent downside potential.
And
It's
I feel like it's
scary.
just opening up, right? And gamma neutral is just flat. Like,
Well, here's, I mean, here's the thing. I mean, here's kind of what I think is going on. Uh, and, I don't think it's that harebrained. It's pretty simple. The really big boys, like the JP Morgans and the Bank of Americas, they're selling all these puts and they're using all of this underwater collateral as their collateral for their margin to sell these puts. And then they're taking some of those profits from the puts to
buy
hedge with
calls.
zero
Yeah.
DTEs.
I mean,
Yeah.
synthetic long is perfect if you're selling equities, right? If you can go synthetic long across the ETFs and indexes, you can drive them up on the
Yeah.
backs of the
Like
market makers, right? And then
synthetic long calendar spread kind of thing.
yeah, and then you just got to sell your equities without, affecting any significant price change. But,
Yeah.
eventually, like, I was talking to some people last night. Like, eventually, the tail on that becomes too heavy, right? And you either get haircut by the DTCC, which
Which
already
happened.
happened, yeah,
Yeah. That was
or
huge.
your tail
We,
collapses, or
did we,
maybe we
did we
find out
talk
this
about the
week
haircut?
both.
Did we
Uh,
talk about the haircut in
I've
detail?
talked about it a little bit, but you can dive into it more if you want.
I just love. I mean, I've already said a lot of this on the Discord, but I mean, if you look at like what they cut for 100%, like no more, margin for it for these at all. Jumbo loans. What did J.P. Morgan just get a ton of
Yeah.
when they acquired First Republic Bank? A bunch of jumbo loans.
Yep.
So I think this was DTCC telling J.P. Morgan that you're maxed out, buddy. You don't get any ideas using this to pump more tail risk onto us. And I think that sort of helps with this idea that all these big boys are just selling tons of volatility, which I think is pretty obvious. But yeah, I mean, if you look at just historical VIX, we're definitely kind of getting to that kind of to the extent of what they can sell. One interesting thing to note is the VIX options chain. The I can't remember which one of the neutrals, but one of the neutrals was dropping pretty precipitously, which was strange because it was very
It was
elevated through.
Vana.
Yeah, it was very
Vana fell off really
elevated.
hard.
It was basically elevated and flat through all of 2022, up at like 90, like super
Yeah.
high. And then from December, when all of the short vol started being sold, it just started dropping and just kept going. And now it's gotten down to about 45, but it started to stabilize at 45. And so I think
There's
I
about a negative 174 billion in like current like short vol interest on VIX futures that's popped up over the last like 3 weeks, 4 weeks.
short vol.
Yeah.
Ugh.
I mean, you could just look at like the short interest on some of these guys.
But
Some like
it started falling off this week. Like it was higher. But now it's down to like 100. I think it hit like 280 something, but now it's down to like 174.
Yeah, I mean, but I think this is just the bank saying like, well, we have this underwater collateral. Let's start putting it to work to try to keep everything afloat, and that's what they're doing. But they're kind of getting to the end of what they're able to do, and so it'll be interesting. I mean, we've been waiting for the drop for months now, and it hasn't happened. But it just keeps looking worse and worse. It's not looking better.
We've gotten some nice drops though. I mean,
Oh
I
yeah,
know a
for
lot of
sure.
people went into this weekend upset, but I loved this week. It was fantastic.
There's a lot of volatility that was fun. Yeah.
Yeah.
yeah, I mean, it's So, the thing is with the like the whole sell off thing with the synthetic long, right? It makes sense from the perspective of a bull because you can sell and then go synthetic long to maintain upside exposure as if you were still long. The vol shorting, though,
I mean, vol shorting's part of going synthetic long.
Yeah, it's
right,
kind of the same. It's a different
Yeah.
way to do the same thing.
right, that's true.
So yeah, so you're gonna kill two birds with one stone.
My guess is it's an issue with liquidity. Their positions are so large, they just want to try to spread around their short vol to as many different instruments as
Don't
they
forget,
can. So
yeah,
they're
don't
shorting
forget the
futures.
like synthetic long is cheap as long as you can maintain the upside, right? But you get all that leveraged downside exposure, and if you lose control of it, it's really bad, right?
Well, like on the same vein with liquidity, right? It's also a settlement thing as well. When we're talking about, your long positions and shares and those things, um, you're dealing with T+2, right?
Yeah,
And then some extra time for APs and whatnot. But when you're dealing with options and derivatives contracts, those settlement windows shrink, and your likelihood of having unsettled funds is greatly diminished, right? And with high volatility, you want to be able to have settled funds to be able to make moves with.
yeah,
I think that's part of the incentive also to switch over to a derivatives-based long position rather than a equity-based long position, right? We'd rather have the
Well,
market.
it also allows them to. I mean, they're basically just selling the put contracts to everybody who's holding long positions and is scared of the downside, right? While they're selling all their long positions.
Yeah,
yeah. I mean,
yeah,
if you look at, I mean, it's really. I think at this point we don't need to theorize about it anymore, right? It's really obvious. There's like five companies holding up the entirety of the S&P 500. I mean, by weight. I mean, have you looked at the
Yeah.
yeah, by weight, I mean the S&P's already basically crashed. It's just those five companies holding up index prices. Um, the
It
the,
is remarkable.
the breadth is disgusting, right? And we talked about it for a long time, but now that breadth data is out there. It's public. Everyone's been looking at it, and it's starting to become more obvious to everyone. Um,
yeah. I mean,
and
you open up the Robinhood app and you see the top 10 companies in SPY are consisting of 30% of its total equity.
yeah, not
Like
well. I mean, you
that's
have Apple
insane.
and Microsoft alone are 15% now, 14,
Just about,
15%.
yeah.
Yeah, um, and
Highest
and they're
ever.
both coasting at higher prices on year-over-year earnings that are down 25, 30%. Right, and that's across the board true for all of tech. They're beating these
Yeah.
like low ball estimates from the analysts, and that's driving some near-term euphoria from long holders that are capitalizing. But what happens at the top of all those runs, right? Like those long holders aren't going to remain confident in those positions.
No,
Yeah,
and I
I mean,
mean,
we're still just waiting for it to go down, but it
Like, I mean,
keeps
for me, like if I was a meta holder, I'd be more scared at 230 than I would ever be at 140. Like,
especially if
yeah,
you bought in low, right? I mean, you want to
yeah,
just why not just lock it in? It went up so quickly.
yeah.
Yeah, I don't get it. Meta
Nvidia's
has
up
just announced
100% like over the last 2 months.
these companies are invincible though, and I think some of
Apple's hitting
that
all-time highs.
you know what? It comes down to this though. It is all liquidity driven, right? So these companies still have money, right? They still have cash. They haven't needed to do any sort of capital raises, right? Well, some
no,
of
I mean,
them
No,
did, but
face.
Meta. I mean,
That's what Meta
yeah,
just did. Yeah.
Meta's
So
selling
did
bonds, right?
Nvidia. Everyone
Yeah,
ignored it, but
Nvidia had a shelf offering for like 10 billion, and then Meta's selling bonds. Some of those bonds are like 40-year notes, 40 years.
that's how they minimize their interest rate, right? I mean,
mhm.
that's what they're trying to do. But yeah, so until we start seeing more and more need for debt, right? Right now, there's not a big need for debt still because everyone loaded up with low interest rates and they're kind of still riding high off their profits, they made off it. But as that increases, especially now that the credit crunch has begun, and I will die on that hill readily. Now that the
I don't
credit,
see it.
you don't see the credit crunch?
Nope, not at all.
Okay, so when you look at the 1 month, you don't see a credit crunch.
When I look at the rate at which banks are issuing new credit, it's going up
Yeah,
exactly
banks
as
haven't
much as it
stopped lending.
was.
He's
So
right.
have you seen the percentage of banks tightening lending standards? It's pretty much all of them.
It's
Some banks, right?
I
But
mean,
the totality, somebody's giving out more.
They're
right?
still
I mean,
higher, right? Like they're still at historic highs. Like they've tightened a little, but they haven't tightened sufficiently.
I mean, basically,
Which just means that the tightening is going to occur over a shorter window. I don't disagree that we're going to see a credit crunch. I think it's almost inevitable and probably going to happen in like the next like 6 to 9 months. But yeah, the banks are lending. They're lending like fucking crazy because they need to balance that that duration risk on all the fucking lending they did at low interest, right?
Yeah, they're going balls to the wall.
They need to get those higher interest rate assets locked
there
in
was that
while
like
interest rates are high.
there was that acute drop off, when banks were failing. So you saw like the credit went down, right, and it spooked everybody. But then once that sort of ended, it just started trending right back up, and it's yeah. So yeah, but anyway, let's assume that the credit crisis has started, or the credit crunch. Sorry, I interrupted you, Dork.
No, it's all good. I'm just trying to find. There was a measure on Fred that I was looking at, but I can't find it now. Whatever. But so mortgage application. I'm talking sort of bigger picture here. So the credit crunch isn't necessarily being felt through businesses quite yet. Small businesses, I think, are going to be obviously small and medium businesses are going to be the ones that feel it first economically, but right now the consumer is the main one sort of getting crunched, right? You have
that.
Yeah, you have credit card debt rocketing, you have mortgage applications crashing. It's the type of debt that these banks are lending out is not sustainable. It's not healthy. It is purely a cash grab, right? So can you really say that the debt market is in a state of high liquidity? I would strongly disagree, and that's why I think it may not be, and especially with M2 shrinking. I mean, it had a small bump last whatever, but with M2 shrinking, right, which is a very slow run on the banks. You're getting tightening lending conditions, and they're tightening pretty quickly. So I guess it's not necessarily a credit crunch in all the classical senses that we're not having.
Let's call it a credit compression. Let's call it what it is.
Yeah.
Right.
Yeah, that works. I like that.
It will crunch. I have no doubt. Also, this in from Bobby Peener. I don't know what it means, but let's talk about it.
Bobby Peener?
No, his name's Bobby, and his message was Peener.
Oh.
Yeah.
Thanks, Bobby. I agree. Yeah.
Yeah.
Peener, comma. Or is there a comma on all of them? Is the comma important? Was there more?
No, it's just Peener. Nothing else.
Peener. Okay.
I'm down for it. Take Peener.
Yeah. The auto industry is insane. I have heard stories that it's much harder to get car loans.
It's getting there, yeah. I've been trying to keep myself abreast of the auto market. It's getting worse. Also, Carvana's fucked.
Again,
I just want to say that no, overall, Carvana's fucked. For all the people that keep asking me if it's gonna short squeeze. The shorts are winning.
The shorts will win.
Probably, yeah. They usually do.
Speaking of shorts winning,
actually with Carvana, I'm not sure, right? So So if we want to dive into some tinfoil here,
Oh, God.
right? Okay, here we
I mean,
go.
yes, I do, but
We're
Okay,
about to get a healthy
here,
dose of
let me lay
Keener
out my
here.
let me lay out my Carvana short squeeze thesis for you guys. Okay. Um, so Carvana, right? They've got a shit ton of inventory, right? And they have been remiss to dump it. And that may be because some people who are, up in the upstairs office are kind of thinking to themselves, if we start selling some of these cars, they're going to go down in price. Well, we dig into the so with this whole duration risk thing, right? We talk about it with treasuries because they're treasuries and it's basically dollars, but dollars are so freaking liquid that and they're not tied to any particular, I guess they're tied to every single asset, and in that sense, the risk is super duper distributed. But when you talk about a asset specific security such as an auto loan, right? That's an auto asset backed security, an asset that's backed by a security that's backed by a depreciating asset. If the value of those assets depreciates faster than the loan is getting paid off, right? The lender ends up underwater on the loan, right? The owner does too. Everybody's kind of in a shitty situation. So I think that there is a lot of inventory sitting around, not just for Carvana, but for this, for dealers, banks that have repoed, everybody. Same thing with homes to a smaller degree, but more so in autos. And they don't want to sell those assets because as soon as they do, their valuations dump, and then they have to basically absorb losses, right?
Yeah.
As soon as they mark those assets to market. So in order to keep Carvana, even though they're on the ropes, in order to keep Carvana from liquidating their auto assets, I think banks are putting capital into the company in order to keep it afloat and keep the lights on. So if the auto industry really does deteriorate, there could be one good push from the banks to put capital into not only Carvana but other companies, publicly traded companies or private, that deal with directly with auto assets. And if that's the case, and there's a massive short position on Carvana, which I haven't checked in a while, I'll be honest, because I'm not necessarily playing this at all, and I think it's a terrible idea. Nobody should ever do it. None of this is financial advice.
You think they can net their inventory?
Right.
Too much. Okay, I'll say this. They don't have enough market share. I don't think they have enough market share to create artificial demand. I mean, we see all these companies trying to create artificial demand right now in order to prop up their massively overinflated inventories, right? NVIDIA's cutting back production, TSMC's cutting back production, Samsung, Carvana is going to probably try to cut back car sales in order to maintain an artificial inflation of the market. I don't think Carvana has a big enough market share to pull it off. Someone like NVIDIA with like a third of the usable or like a third of the manufactured chips in existence, sure, but Carvana, no, too much competition. Also, private sellers, the private seller market can upend all of that.
Yeah, and that's kind of the thing that the banks can't control, right? But I'm more talking about the other side, right, where the assets do start depreciating, or maybe not. Maybe just Carvana, their operating expenses become too high, and they have to start offloading cars at a discount to once again keep the lights on, right? And those sorts of things, even though they're not huge, they're not massive, little ripples through the asset markets like that, or something like Lennar, let's just say, selling a bunch of homes at a discount, right?
Yeah.
Which that could happen. Those sorts of things have knock-on effects in the asset market that are like dominoes, right? So that's why banks will fight to raise capital for companies that are facing asset sales. That's why JP Morgan and whoever else went and dumped deposits into First Republic, who then went bust.
So I think on that side I can identify the point of failure in the thesis also. I mean, just to play devil's advocate.
That's okay. This is a
very
fast.
I think there's a lot of volatility shorting on Carvana. Obviously, that's gonna create similar effects to what we've seen with GameStop and everything else over time, right? Where we're gonna have those big like pullbacks as they try to draw in more liquidity. But on the manufacturer side, you have PPI prices coming down, right? And manufacturers are going to start buying into futures and getting commodities as cheap as they can, right? And then manufacturing and production is going to explode, right? So the auto manufacturers are going to try to pump out as much inventory as they can on those low price of commodities, right? And that's gonna weigh pretty heavily on the opposite side, right? Because you have all that new car inventory coming in.
That could trigger another commodity super cycle, though.
Yep.
That would be. I mean, if that happens, man, JPOW better put the fucking hammer down on these losers, because
I feel like JPOW is waiting for it and it's just not coming, because there's just so much stability, you know, with people. I kind of talked with JFresh last night about like how this really looks like cost push, right? And you know, that kind of fits into that economic model where, you know, except instead of consumers demanding higher wages, the consumers are weak, right? Like the proletariat isn't angry enough, and so they're just taking on additional jobs, right? So instead of going and demanding $30 an hour for their full-time employment, they're just taking two $15 an hour jobs and working even more. But they're maintaining that higher buying power like they were receiving the wages, and I think the Fed's still really focused on that wage growth, but I think they should be more focused on the fact that unemployment's going down.
Yeah, that was crazy. The employment numbers really surprised me when I saw them. That was interesting, but I mean, you know, people say that, and this kind of comes back to what I was saying the last time I was on about the fundamentals of the economy, right? When, you know, you think about a company that doesn't have enough people, you know, staffing their stuff, you know, that company, you know, you could think of we can't hire enough people as bullish, right? Because there's just so much demand, but you could also think of we can't hire enough people as bearish, because that means growth is going to stall.
Productivity is gonna fall off a cliff.
I mean,
Yeah.
productivity is going down, right?
Yeah,
I
it
mean,
is. It is.
the print on, I think it was Thursday, that looked at quarter over quarter wages up over, you know, around 6%. A lot of that was due to a reduction in productivity, right? So it's an effective wage increase because productivity's been dropping, which is interesting to me. But yeah, I mean, productivity is dropping, wages are still increasing, prices are still increasing. It's just not accelerating yet. It's sort of flat, and so there's still, I think, you know, Girk, you hit the nail on the head months ago when you said the market craves data, it requires it. I think we're still very much in that regime where the bulls and the bears both have their theories, for good or for bad, and they both feel very strongly about it. And there's just not quite enough data yet to really bury one or the other. And so we're just going to continue to bounce around as everybody's just like, is it going up a little bit? Is it going down? Trying to read trends through the noise. We're still just in noise, and it might be another couple months before we have any more clarity. I wouldn't be surprised if we go into the next FOMC meeting and they're just still don't know what the fuck to do, because it just looks kind of like nothing.
So if you guys don't mind me going half walk in here for a sec.
Okay.
Go full peener.
I'll go full peener here. So, you know, the overarching theme of the past 3 years has been a shift from people working, you know, jobs that had a specific task at hand, right?
Yeah.
To a regime where we have a large subsect of people driving for Uber 4 hours, 5
Let's
hours a
just
day.
call it
And then,
let's just call it doing shit for money.
yeah, well, they're
All
doing
right.
a lot more for money, right? But
Yeah.
then you have a whole other subsect of people a lot of them that are glorified latte sippers, right? People who they're marketing executives for Facebook or whatever that are getting paid 250 grand a year
Careful, I
to
can't
sit
afford to
around
lose any
playing.
more people from the pickle jar.
It's true, but I mean, so I'm sure there's plenty of them here. They're all over the place. But it's just people got hired to do jobs that were very nebulous, right? And there's still a lot of nebulous employees floating around in the economy, collecting their paycheck and brainstorming, right? Sitting in groups and having huddles and scheduling meetings for other meetings to have a meeting to do another meeting. It is the way the industry has shifted, and it's not sustainable. It's not actually based around rational, reasonable, sustainable growth. It's based around being able to hire all the visionaries in the world, and those visionaries are just going to make profit rain from the sky, which is only partially
Yeah,
true.
but the modern economy has actually been like that for quite a while. If you look even uh, one example, so I'm going to shamelessly plug something, and I think I can do this because the guy is dead. Unfortunately, he died suddenly, but he's the only person that's made me feel like the study of humanity is actually interesting and useful. His name was David Graeber, and he has a book called Michael Jackson, David Graeber, and he has a book called Bullshit Jobs: A Theory, where basically he says that, and his definition of a bullshit job is whatever the person who has the job will admit that it's a bullshit job. And there are surveys that were done, and it's something like 40% of people believe their own job is a bullshit job. And so we're definitely in an era where this idea of capitalist efficiency in the labor force is a fairy tale, right? I mean, it's a fiefdom where people vie for control and vie for the size of their little fiefdom. And yeah, so I mean, and one example that he gave, which was such a great example, was one of the reasons that Barack Obama didn't push for universal health care back when he was trying to reform healthcare back in 2008. One of the reasons that he gave in a television interview was, what are all of the people working in the insurance industry gonna do? Where are they gonna go, right? Then you think about like automation, self-driving cars. Obviously, those have taken a long time to play out, but
Say
something like
AI. Say it.
a
Say
machine learning, something like at least a quarter of all like jobs are just driving shit from one place to another for people, right? So I know that it took a long time for the horse to become obsolete, and it'll probably take a long time even still for the humans to become obsolete. But we're definitely dealing with an era where most jobs are unnecessary. Um, and I think as money gets tighter, people are going to feel that effect. And I don't think it's a coincidence that tech is feeling this first, right? Because that's where most of that's where the easiest money was, right? All the venture capital money, which is just people that have too much money trying to find something fun to do with it, right? And as that dries up, right, all the shit kind of boils up real quick. And so like California is a mess right now. Everywhere else is still kind of fine, but
Yeah,
California is like basically on fire.
and this is kind of, yeah, that's kind of what I was
Is
getting
it
at.
literally on fire? Is it the season?
I
We
don't
had a
know. I mean, it might be, but no, I don't know.
we had a great
I mean,
winter, so it's fine. But and I'm not saying that the bullshit jobs thing is a new phenomenon. I'm just saying that in 2020 through 2023, it got pushed into overdrive, with all this
yeah,
free fleet. And the thing is, though, is to unwind it, right? It could be a protracted experience. I mean, layoffs right now are still bullish because numbers are still above 2019 levels for a lot of these big companies in terms of how many employees they have. But as profits start to drop, if inflation persists and people do change their spending habits, which right now they've only changed their financing habits, if people start to change their spending habits and these margins finally compress, you know,
They
it
already
could
are.
still
The margins are compressing. The
Yeah,
analysts are
10
ignoring
percent,
it.
10-15% everywhere.
Yeah.
but they need to compress more, right? And
Well, they will.
Oh,
the
yeah.
unwinding of this employment bubble is going to take a long time, especially with the Great Resignation that also happened.
Yeah.
There's going to be this really weird, and we're already in it. It's just this really weird period where employment is going to stay ridiculously high. Even as layoffs increase, employment could just stay high, like in a total counterintuitive way, just because people will lose one job and go to another until they can't, right? Just job hopping to either higher wages or job hopping to lower wages once, margins do compress for, even further, to where people can't offer competitive wages anymore. They have to offer, like, people at that point, the employees are offering the competitive wages, right? Needing to settle for less and less.
Yeah.
But that's a very drawn out process that could take upwards of, like, a year, 2 years to really, really fully unwind, or at least return to mean or somewhere close to it. So,
Yeah.
Yeah,
I
I
mean,
think
And
I think
poopy pants. Oh, sorry. Go ahead, Jay, first.
I was just going to say, I think one thing that we've learned through the quarter one earnings is that what we were, it can be a little frustrating once you've sort of seen enough moves ahead that you already kind of see the checkmate. You just want it to hurry up and get there. You don't want to sit there and watch the game play out because you already know what the conclusion is going to be. And I think we've learned in quarter one that we've simply been too early. The data is still noisy enough and inconclusive enough to allow people to remain bullish, right? People are inherently optimistic when it comes to the markets, historically very optimistic, and it allows people to continue to remain optimistic for
I
longer than we expected. And so I could see this going on for even another 9 months. I mean, at some point this year, I think it'll become apparent which way we're going to go. But
so I think a lot, and this kind of expands on me and your conversation from I think it was last night, might have been the night before. I spent a large portion this weekend pretty drunk, but I think that effect specifically right now can be blamed almost entirely on the Fed. I mean, if you look at the way the Fed has progressed through this period, and like if you try to define the model that's defining their understanding of the current macroeconomic environment, I think you see this thing where they move from like the Phillips curve back in like 2021, where inflation is transitory and you don't have to worry about like NIRU, which is like a non-accelerating inflation rate of employment, or of unemployment, sorry, into like the beverage curve, right, where all the fucking economists are like, oh,
they're going nuts about this curve.
oh yeah, but they're behind. They're wrong. I think all of the economists are wrong, and I'm right.
If you guys want to
well,
go,
I'll
and
tell you why, because I'm smarter than them.
Hold on.
But yeah, they're all focused
Nobody
on the
here knows
beverage
what
curve right now.
Nobody here knows what the beverage curve is. Number one.
Oh,
So
okay.
we
So the
should explain
beverage
that. Number
curve
two.
depicts the relationship between job vacancy rate and the unemployment rate, which was something the Fed was really focused on in the latter half of 2022, right? And now all the economists are really focused on it because they think they figured out what the Fed's thinking in hindsight, which I do too. But I think the Fed's moved from beverage to cost push, and they understand. I think back in January they understood that we were never going to see the vacancy rate that we want to see, and they moved into cost push. And the only problem right now is that they have yet to realize that when looking at cost push, they're still targeting that price stability through wage reduction, but Americans are willing to take on more employment in order to offset wage reduction, right? And so
We're gonna buy, baby.
the general public is, kind of like Poopy Pants just said, they're pulling up their bootstraps, but they're pulling them up so much they're turning into pants. And so yeah, I mean it's and I think that's where the Fed is now. And I think it's a very short, we have a very short window with that stagflationary GDP data till the Fed accepts the fact that people are just working more jobs to create the wage increase that the corporations are unwilling to pay out.
Well, yeah, I mean, this is
And I
is
think
the
when we
thing,
get
right?
there, the Fed has to act again. They have to act similarly to the way they acted at the end of 2022, because
And,
otherwise
and
we're
it,
looking at 5 years of stagflation.
yeah, but this sort of just kind of goes back to just fundamentally what inflation is, right? It is in the face of increased aggregate demand. Nobody wants to hold the bag, right? And so you think about, you know, you're talking about what everybody's doing here.
Alexa, play
It's
Despacito.
I think it's pretty clear here that nobody is willing to hold the bag, right? Employees aren't holding the bag, employers aren't holding the bag, government hasn't really done a whole lot to hold the bag, right? And so until somebody holds the bag, prices are going to keep rising, and I think that's right.
I mean, we hit
But
stagflation and everyone holds the bag,
right,
right? So there's a crunch, and
eventually someone has to hold the bag,
yeah.
or the economy, or the money becomes worthless. One of those things.
Well, I got a chart.
Oh, I've got a better one.
You haven't even seen my chart.
Buddy,
Me
come
first.
on.
Me first.
Hey, what you got
Fine,
for me,
you
Dork?
first, send me. It's in the chat.
All
If you
right,
want.
I'll open yours first.
Yeah, come on. You got to lead with the mediocre.
Mine's more compelling, so it's fine.
Okay,
What?
it's
Okay, we're looking at the
How do
velocity.
I zoom in on this? Hold on. This is terrible. I need to find a way to do this better.
People are spending.
Yeah, they are.
I mean,
Where does that data end, though?
the data. Oh, where's like the start of the data, or like
No. Where's the most recent data? I know
so the
sometimes
most
the
recent
Fed.
print was April 27th.
Oh, this year
Yep.
on this chart.
This is
Okay,
the
yeah.
M2 money supply, or the velocity of the M2
Velocity,
money
yeah.
supply.
So
On a
how
year over year.
often, how quickly money's changing hands?
But this isn't just the velocity. This is the year over year rate of change of the money velocity. Okay.
Oh, okay.
So here I'll put another chart up
Let's
too, so we can
see. You could even
compare the
say it's
actual.
the normalized acceleration.
Right. Yeah, that's another way of putting it. Yeah, the normalized M2 acceleration. Here's the actual Here's the actual M2 money velocity.
He just popped it up on TradingView.
Did he? Nice.
Yeah.
So the velocity of money, right, is a really interesting thing, but this kind of is the crux of what drives inflation, right, and what kind of relieves inflation. Okay, and we saw a massive drop in money velocity in 2022, and the reason why is because you could think of it like money, like M2 is like a giant pile of cash, right, where there's cash going out in a tube and cash coming in a tube. And what happened in 2020 was, the Fed basically just took a gigantic bucket of money and put it on the pile, and so the pile got way bigger. And so now, but the flows in and out have stayed largely the same, right? So, we've seen sort of prices go up and stay sticky because money hasn't been moving fast enough to create, liquid changes in price. But we're seeing a reversal in that now, right? And this doesn't. It's sort of directionally agnostic unless you like chart CPI over it,
Yeah.
sticky inflation over it. But what
I
this
think
tells you,
I posted that the other night with like the sticky inflation in the
okay, yeah.
Discord. I'll have to find it, but it's in the SPX chat somewhere for you guys.
But yeah, the year over year rate of change I thought was really interesting because we haven't seen this rapid of an acceleration in M2 velocity ever, at least as far as the data goes back. So this is a really strong indication that there is going to be some sort of shift in inflation, whether down or up, right? And just based on the way demand is holding up, it looks like it's going to go up. However, I would posit that if we look at this with the consumer savings, which I don't have up, but I could add that. But anyways, if you look at consumer savings, right, they're just actual M2, right, going down. this could actually be a sign that we're reaching a stress point overall in the dollar market and just the overall spending money on stuff, world. And if that's the case, then velocity will continue to pick up, but we may see inflation reverse strongly to the downside. It may go up and then reverse super hard once that pain point is really pricked. Whether it's the consumer or if it's companies, it's probably going to be the consumer first, then companies. You look at credit card delinquencies; they're not like the number of delinquencies isn't that high yet, but the rate of change of the delinquencies is really, really high. So there's definitely this is all reaching a head, at least in terms of
Auto
these
loans also, and now mortgage
Yeah, I mean, I
delinquencies are
think
starting to
consumers have
rise.
made it pretty clear that they're going to keep spending until it is all ripped out of their hands.
Well, they're going to keep spending until they lose their job,
Yeah.
right?
Yeah.
Or lose their third job.
Yeah, as they lose income, their spending habits are gonna change. Like I said earlier, their spending habits haven't changed. Their financing habits have, right? And that's kind of it's a dangerous game we've played, especially when we dropped interest rates again. I mean, we've kept them super low since 2008 and just dropped them to nothing, for a solid year, a year and a half, even longer, really. And what that did was it created so like you can imagine how many people were dipping their toes in the credit waters, whether it's a home loan, an auto loan, a credit card. They really got access to a ton of financing back then, and that financing is still there, but now at an increased rate. So there's it's reaching some sort of crazy, wacky pain point where kind of like the big companies, like how I was saying, they're going to need to be raising capital more and more. Same thing with individuals; they're going to be needing to finance things more and more, and it's just going to drive the velocity of money up and up. And so any change in like the volatility and inflation is probably going to start picking up to the upside and the downside as inflation expectations go up. People pay financing, and then that it could
Well,
go
don't
down.
forget that we have an expected spike in inflation at some point due to the playing out of that supply chain bullwhip, right? I mean,
Yeah.
and we've got to be getting fairly close to that producer pressure. So I don't think you're wrong.
Yeah, so it's just really interesting seeing this play out, especially like I've been watching the velocity of M2 for a little while now, and the increases in velocity, they're needed, right? We need money flowing through more freely than it has been for the past couple of years, but at the same time, I don't think that the commodities market is fairly volatile. The oil market's crazy volatile right now, but like OVX, the oil volatility index, is not that high, right? I just don't think that we have seen the increase in money velocity lead to commodities market volatility to the upside or downside
Yeah.
as much as we will. Yeah, I mean, like the trigger could be just some sort of event that sends oil through the super cycle, right? I mean, it could be anything, but if velocity of money really picks up, those changes in commodities prices, in consumer spending habits, things like that, will start to fluctuate faster and faster until it hits a head. And I think the Fed is trying to beat that, trying to get there before the consumer does, but I don't know if they're necessarily going to be able to unless something big happens, like Russia ends its war with Ukraine and then food prices can start to moderate a little bit, something like that.
Yeah.
Until something like that brings stability into the commodities market, it's just going to stay crazy volatile, especially as money velocity keeps picking up. That's kind of one of the big things that is driving Michael Burry's prediction of a second spike in inflation is that this money velocity reaction, which he predicted promptly in like early 2022, I think he was spot on. Once velocity picks back up, it's going to cause inflation to rear its ugly head again. But the second spike in inflation,
I mean,
is
we've
going to be
already
way more.
been seeing the lead in, right, with this month over month drag as we see core climb, right? And then that durable inflation putting that back end pressure on not just US inflation, because US inflation's already packed in a lot of durables inflation, but foreign inflation has not. Foreign inflation is almost entirely headline and energy based. They have yet to get hit with the after effects of American purchasing power in the durables market, and I mean, you could see foreign inflation rise to levels where we're just raising rates to keep up with, like, the ECB at that point, right? And like they have to go much harder on inflation than we do, and they've taken a softer stance, more dovish stance so far.
And you've seen what inflation has done in the face of that
Yeah.
in Europe, which is go up, up, up. Like, yeah, this is kind of why I made that bet with Mr. Poopy Pants too. Is that European inflation being mainly energy driven is it's still like the lagging effects are even more lagging. When they have to travel through the dollar market first.
Yeah. Well,
So
they're also just way softer on. I mean, they're way more dovish on their central bank policy and their monetary policy.
yeah, for now, I mean it could change.
But I mean, Europe looks like it's heading towards uh
Europe,
austerity measures. Like UK and Europe look like they're gonna have to hit some kind of austerity for a year or two.
I mean, yeah, I mean Europe's already in like pretty deep in a recession, I would say.
Yeah. Well, in the interest of ensuring that no one spends the rest of their day flaccid, I will give you guys this to discuss.
Full peener.
This is the US 5-year CDS, which has increased from April, well, let's say from the period of the bank failures around March 24th to now by almost 30 BPS. So if anybody's wondering where all this bank risk is going, I think I found it.
Well, yeah, this is
Who's the
full on.
counterparty to that dog shit?
And then
That's
wait
right.
for it. It gets even better when you look at it on a historic scale.
Hit me with the 10-year.
I'm gonna hit you with from 2008. Hold on, that's not
Oh
it.
yeah, give me
That's the wrong one. 1 second. I've got the other chart here.
You're edging me so hard,
I
Gork.
know. It's
What you got for me, Gork?
Ready?
Ooh.
Now, when bank failures start to go up and banks need to hedge their failing assets,
That's compelling.
isn't that hot?
That's so hot.
And if you actually look at the rate of change over time, it is far faster now than it was in 08.
Holy cow.
And mid 08 to 09.
So these
Yeah,
are sovereign CDS, right?
Yeah.
Oh,
so here's
that's
my
hot.
question.
Oh.
What's gonna break first and when?
I mean, this looks like it's gonna break real soon.
Yeah.
This is from March 3rd. US 5-year CDS is at 37.86. It's now at 73.37. Or I'm sorry, 75.37.
I bet on shorter dated sovereign CDS, I bet it's even more pronounced. Like on the 2-year.
Here,
So-
I can show you that.
So could this? I mean, one of the things I was hoping.
Do you want to see? Do you want to see the sovereign debt risk, Dork?
Yes.
Yeah.
Yeah.
Yes.
You want to see it?
Yeah.
All right.
Yes. Give me it.
I'm warning you now. You're not. I think you're probably wearing too many clothes. But
all I have left on is a condom.
oh, okay. Never mind. You're ready. Fill it up.
Do I need to put my Depends back on?
It accelerates.
Oh my god.
Nice. And Canada for the win.
That's just 6 months. Yeah, this is just
okay. Yeah. So so maybe we should for the smoother folks in the crowd kind of talk about what we're looking at when we're looking at
gun it.
Yeah.
I'll leave it up to you.
So, a sovereign CD, like a credit default swap, I'm pretty sure everyone here has watched The Big Short. They kind of know what it is, right? It's an insurance contract on your bonds. These are insurance contracts on treasuries, right? The most secure asset in the world. This is the price of insuring your treasuries. So the market currently is buying like so much insurance on their treasuries that it has pushed the spread on their credit default swaps up by 100%.
More.
That's yeah, over 100%. It's fucking crazy. Like that's it's a very clear signal, right? When this happens on a company, right? When it happened on Credit Suisse, they died, right?
In February of 2022, the spread was 13.11. It's now 75.37. So
Oh,
it's
it's like
7x. Yeah.
Nice.
That's crazy.
Pump it. It's a new Pepe coin.
I mean, apparently.
So I wanted to find the fat tail for you guys.
That's a pretty fat tail. I love it.
That's literally the fattest tail you can possibly have is in the treasury market. I mean, that's
so we got all these banks scrambling to survive, even while holding all of these very.
I think that implies something even more, though. The rate at which the spread has increased since the initial regional bank failures imply, because how large those increases are, right? We've seen, a 40 basis point move in the spread. That's not smaller entities with the liability. And I think that data point confirms our floating rate risk treasury short thesis.
I think so too. I mean, yeah, this isn't some sort of sentiment thing. This is people putting their money where their mouth is, right? It's one of those are the best indicators.
Yep.
And this is a lot of money being put into insuring against a default in the US Treasury. Which yeah, it didn't happen so there's been times where we've had debt ceiling increase stuff happening, right? In that chart you showed the longer term 5-year CDS chart. There's periods in that chart that I was looking at that were where the government was actually starting to close up shop on some stuff and actually start to shrink operations in order to deal with they had shutdowns. They had actual shutdowns happening and CDS didn't spike like that. Not even close.
So, I mean, that's why I live in Texas, is because I was in DC in 2013 when they were shut down for like a month. It sucked.
Yeah,
since the bank failures, the spread has increased 68.89%.
Oh my god!
But it's also coming up. It's also correlated with the approaching the X date, right?
What do you mean?
I mean, for the sovereign debt, I mean that probably has a lot to do with just the X date.
Yeah.
How much did it go up since? When did Yellen say we had? What day did she say we had till June 1? Was it like Wednesday or Tuesday? I can't remember.
From Friday, April 21st to today, or this last Friday, it's gone up from 53.31 to 75.37.
Yeah. Okay. So it's still a lot of it is front loaded to something else. Yeah.
I think we were in a really big confluence of craziness, right? Like we've got the debt limit talks going on. We've got banks failing. We've got margins compressing. You know, the amount of tail risk just in the bond market in general isn't going down. It's only going up. I mean, anyone who wants to raise capital is going to have to do so at least a 4% APR, right? And that's if they're like a big company like Google or Apple. Or they're doing like 40 fucking year bonds like Meta, and then they can maybe get a competitive rate. But the risk in the bond market is not going down. The amount of like the money flow, like the outward pressure, right, on money in terms of in the system is not letting up. Like money is just it's like J Powell basically yanked the drain plug on the bathtub, and then he drilled a few holes in it too. And even that's not enough. He needed to just smash it with a sledgehammer. But that outward flow is not going away.
No.
So the amount of just tail risk in pretty much every single bond out there is insanely high, right? The incentive to insure against it is only going up as this drags on longer, and the more that the Fed says we're not cutting rates, right? Even Jay Powell, I listened to a little bit of his speech, and he basically just said all the measures we look at say inflation is way too fucking high. Go fuck yourself. Basically all he said.
Yeah, but it's the way he said it, right? I mean, he's kind of in a position where he simply cannot. If he just comes out and says we're all fucked, right? Then everything crashes, guaranteed. So he literally just has to come out and try to just BS his way through it by, everything is implicit. Everything he said was implicit. There was no explicit statements, not a single one in his entire speech. And so it left the viewer to put the pieces together to come to their own conclusions, which allows people to kind of, use their own internal bias to decide what it ultimately meant.
I mean, that's their last tool, right? Is going dark.
Yeah, but I mean, the way that he was speaking, it was so over the top, convoluted, and even for him, right? I mean,
I agree.
it was. I think he was like the roller coasters, going through the corkscrew.
I liked when he laughed about the
onto the
rate
railing with
cuts.
one hand, like out of the cart.
I didn't. So he laughed when someone brought up rate cuts.
Yeah, he actually laughed in their face.
Okay, well now I like J Powell just a little bit more.
Do I humor Watkins' claim to have her having a valid theory of anything?
No,
All
you
right,
don't need to yet.
I don't think so. If he'd ever supported a theory with facts or ideas, then I would have listened to it. Mostly it was just ranting, anger, like repressed anger. I don't know.
Very angry.
Yeah.
Well, like Watkins' market crash thesis was like his market crash thesis was human greed, the end. And I was like, okay, you're not
that's
wrong,
great.
but
It's always he's still banned until the market crashes. So,
Okay.
Don't worry about any reprisals.
I love that. He's banned till the crashes.
So speaking of banks, do we care about them talking about a short sale ban?
No, I don't think so. The last time they enacted the short sale ban, first of all, it was after the fucking market crashed. And that's only to prevent the short sellers from all. I mean, I talked about this earlier in the stream, but I mean, they just don't want all the short sellers coming in and like trying to seller box everything, right? Because they would, given the opportunity, and they need to get long investors to come back. Which they did successfully back in 08, but the SEC already said they have no intention of doing that right now. I don't know why it's trending on Twitter. Probably because everyone who gets their financial information off Twitter is a moron.
Yeah, maybe.
They all bought GameStop too.
Yeah, that also. I mean, I bought GameStop, so fuck you. But
did you buy it at $350 a share?
I mean, I bought a few shares at $350.
Yeah.
Not most of them, but a few. I was hype, you know.
Fair enough.
Well, you were trying to squeeze the spoils.
You're a genuine fellow.
Yeah.
Pulte, Pulte bought the top.
Until Ryan Cohen showed me just how big of a dick he had. There was still a very valid case for a short squeeze on GME.
But yeah, I don't really care about the short selling on the banks. I mean, you're
Yeah.
right. It presents a systemic risk because
It
short
also
sellers.
just increases fear, right? Because
Yeah.
every long on those banks would be like, oh fuck this, and sell. And I also, reiterated the fact that a short sale ban doesn't stop ETF selling, right? So you can still just get all your shorts out of the ETFs and then sell them on the open market, and it's not a short sale. So you can get away. There's ways around it.
Yeah.
Not only that, but the other thing is that short selling doesn't just help make prices go down. It also provides liquidity to market participants in periods when there's low liquidity, right? When there's an excess of selling, the ability to short allows you to provide shares and not fail on securities,
Yeah.
which is a big
Shorts
thing.
also close, right? Which provides buying pressure, which turns selling into volatility, which masks selling, which inhibits fear.
Yeah. And
Yeah.
then produces future price improvement.
Gary, if you're listening,
It's like what DFA said, right? Like all shorts are future buyers.
Yeah. But not sellers. Sellers just go away.
Yeah.
So short's good. But I do think a lot of shorts got out of the regional bank shorts on Friday. I think that was part of the push up.
I think it was
Obviously
a
not
big
all.
part. I think it was a big part of it. But yeah, I agree.
But it's I don't know. I mean, once shorts see blood in the water, I mean the thesis is still sound. They'll come back in, probably more slowly than before, but it's an undeniable value for them.
Well, if M2 money stock continues to go down, like if it resumes its downward trend, that's a pretty good sign that you should probably continue to short regional banks, because the more that, like, because that's aggregate deposits, right? I mean, the more
Yeah.
that's just a really slow run on the banks, and it'll squeeze smaller banks first. And this is also part of threading the needle, right? That JPOW needs to be careful of.
Well, careful with how you phrase that. It squeezes more risk exposed banks first, not necessarily smaller. Some of those smaller
Right.
banks actually have less of that duration risk. Some of them are more stable than their bigger counterparts.
Yeah, I guess it'd be a squeeze in liquidity, right? More than anything else.
Yeah.
So, and that does, and anyone who has less deposits is going to feel that quicker just by the scale of things, right? If we're assuming even distribution of deposits, which is, I know, entirely wrong, but if we just assume that, then by that metric, if M2 goes down, then a smaller deposit base is going to be hit harder by the same amount of deposits leaving than a larger one. Like,
We're not getting our next report on M2 money supply until the Fed puts out their chart from the minutes, which will be June.
Okay, we got some time. Yeah. Well,
so a couple
that's
weeks.
going to be interesting.
Yeah.
I don't know if I'm necessarily just going to buy regional bank puts when I see that, right? I don't know.
But that also should theoretically put downward pressure on inflation if the M2 money supply is significantly lower.
Oh yeah, especially with velocity picking up. If M2 drops more, then you could have a significant and hard to stop reversal in inflation, right? That's the other side of the coin, right? The threading the needle is you have to worry about deposits shrinking too quickly. That's people losing money. People lose money too quickly. You could get inflation fixed, let me tell you, but the
there are more robust approaches to fixing inflation than monetary policy. But yeah, I mean that kind of brings back to what like Stefan's always bringing up with the market crashes occur after the Fed stops raising rates. And the reason for that is because historically the Fed always over raises, right? They always overshoot, and then inflation collapses rapidly, and then you're in a deflationary market, and that's why the market crashes. It's not because the Fed's just lowering rates in response to needing to move to quantitative easing, right? But the market
it's
crashes because we've become deflationary, which is far worse economically than inflation. Inflation you could survive forever. I mean, look at Japan. Deflation will fucking destroy your economy
Well,
fast.
inflation is fundamental to modern economic theory too.
Yeah.
Which is, I think, unsustainable in the long term, which is why we have boom bust cycles. Like 0% inflation would be quote unquote ideal to me, but yeah, like the idea that I think
You
that
need some lubricant.
yeah, exactly. JPOW needs JPOW needs
Use it or lose it, right?
exactly, but JPOW needs to like have prices sort of stall, right, to the point where a real wealth can kind of catch back up and hold on to the price increases again, right? Like right now, where you have such a significant impulse in inflation, even if inflation went to, back to like 1% or 2%, if it doesn't stay there for a while, right, in order for wages and savings to catch up before it picks back up again, even if it drops to 0% and it goes right back to 2, we're still talking about elevated prices relative to before the inflationary spike, right? And it's more apparent in the housing market than anything else right now. The auto market a little bit, but mostly the housing market it shows this sort of effect, right, where you have this you have these inflationary spikes, and then especially in like a sustainable economy like the Great Moderation, I would say, into the dot-com bubble.
Yeah.
The housing market just stalled and it held there for a while, and then it kind of picked back up once things kind of settled down. When you have something like 2008, then you're looking at a rapid inflation in asset prices, that, even though it may settle, it doesn't, the economy isn't growing fast enough for people to catch equilibrium to the upside,
Yeah.
right? And so that's, this is the deflationary pressure is really just on whether or not JPOW can slow asset price growth enough, right, to allow the consumer and just the overall economy to catch up to the upside. But I think, especially after the spike we had, he needed to pull out the bazooka, and instead he pulled out the squirt gun. And because he's trying to follow that sort of idea from 2000 that you can sort of moderate growth, and it works fairly well
Yeah, it's
when
not bad.
everything
Yeah, I
when
mean,
it's stable, it's fine. But
we've
now,
had these discussions before of him threading the needle, and there's a lot of reasons why it's already really difficult to begin with, because the system, the data lags, and then the response to the data lags even more, right? But I think an additional wrinkle that's come into play, I think that's been fairly obvious now since the last time we talked about these lag effects, is that the system itself is fighting him. We are fighting him. We are saying, we don't care that you've made everything else more expensive. We're gonna buy even harder
Yeah.
and
full
screw
PM.
you. And we're trying to call his bluff and saying, you're not man enough to raise rates to ruin our lives. So we're just gonna pretend like everything's gonna be fine and someone will figure something out, right? And
Well, raising rates is also just a blunt object. Like he already raised rates enough to ruin lives. I mean,
look,
right now buying a house is next to impossible unless you're trying to move to, like, Mobile, Alabama or something like that, like, or the Bible Belt. Like, that's the only places you can afford a home. But if you're trying to buy a house in like Utah or Colorado or Washington,
California, New York, Maine, Massachusetts, Washington
yeah,
D.C., Florida, Texas.
everywhere, yeah, it's fucking impossible. So like he's already there, right?
Yeah,
And
but
and
no one wants to
every
listen.
yeah,
people are still doing it, right? I mean, they're
Yeah.
still saying, "Oh, rates are going to go down, so I'll buy now before prices rise even more." Inflationary expectation, right?
yeah.
And they're going to get into this loan, and the rate's not going to come down, and they're not going to be able to refi fast enough, and then they're going to lose their jobs, and it's going to be nasty, right? And we could have certainly avoided some of this by saying, "All right, I'll stay in my current house or whatever." Right, in my current situation until this blows over, and not try to overextend myself.
But
But
even
we
to
didn't
that
do that.
Keen's
even to that respect,
Keen's rolling in his grave right now after you just betrayed him like that, Jay Fresh.
Well,
well, so even on that vein though, you could see what happened in 2008 with the credit crunch. I mean, the Fed cut rates, but even so, lending standards were so tight that even if you did time the top of the rates and the bottom of the housing market, refinancing to a lower rate was next to impossible for most people. Just because lending standards were so tight, they would go and apply for a refinance, like on their jumbo loans or whatever, and they wouldn't get it.
Yeah.
Until it took until like 2011, 2012 for people to actually be able to refinance.
yeah. I mean, I think it's a mistake, but I know people who have told me that they're just like, I still think it's worth it to buy a house now.
That's because
Yeah.
of that ingrained idea that houses only go up, right? Like it's like stocks but worse.
Yeah.
Like everyone always thinks whatever piece of shit house they buy will be
Oh my
worth more
God.
in the future, no matter
That's why
what
I
happens. The
That's why I got
faith
the
in
hell
that
out of
system
Washington
is
D.C., man.
unbelievable.
I didn't want to pay $1 million for a shithole. Like,
Yeah.
if you have rats in your basement, it's not $1 million house. It just isn't.
I mean, I think if it's under 3,000 square feet, there's no way it could ever be $1 million house.
Why buy a house when you could be a loan shark? Exactly.
I mean, you could be a loan shark light with renting it out, but
Yeah.
only if you get a good price. Which that's another question
Pants,
too.
you're talking to two homeowners here.
Watkins says, "What if banks are actually well capitalized and strong? They're not. Banks as individual entities are not strong or
Okay,
well capitalized. The banking system, very well capitalized,
here.
very strong.
Can I respond really
They
quick?
certainly have less like risk in the traditional sense, but their duration risk is kind of just screwing them. But yeah, like the traditional risk of like the actual credit repayments and things is certainly much lower than it was during the fraud that was occurring in 2006 through 2008. But there's still a ton of risk, and they're not liquid, and that's the big issue.
So there's over 700 banks right now that are sitting on unrealized losses greater than 50% of their total assets. We'll just put it like that. Okay,
Yeah.
Watkins, why don't you shut the fuck up and sit back down and go back to thinking
Well,
people
I
are
mean,
greedy?
calm down.
Don't you have some beer to shoot?
It's not.
Like,
I mean, it's not that hard to.
It's the weekend. What the fuck are you doing with your time, man?
But here's. I mean, what are we doing with our time? But here's
That's true.
so so
well,
maybe
we're
we should
stroking
make,
each other's egos. We have a reason to be here.
Yeah, I know. It's great. I love it. And people are just here watching it. It's even better.
It's like porn.
Finest.
This is what you've always wanted out of life. This is why you became a professor. An interested audience. And you finally have one.
I get to hear myself talk for, however long I want, and they have to listen, right? They pay for the privilege. There's a lot of similarities here. They don't pay me though; they pay you. But that's how much I love attention. But anyway,
well, you've seen the returns on that. It's really just for the ego stroking.
Maybe we should segue into but Gork puts or calls.
Oh,
are we still in,
I'm still buying puts with theta, calls with none.
Yeah.
I mean, that's the market we're in right now, right? So you accept it or don't, but if you work against it, it will fuck you. So the best thing you can do is, apparently, the last few weeks have told me that I should not be taking any kind of risk management strategy when approaching 0 DTE calls, and I should simply hold them into the end of every day, because I always get stopped out like before noon, and then the price goes up $40 more. And then my puts should always be bought when VIX is low, and they should have at least 14 days to expiration, if not more. But so far, now that I've learned that lesson by repeatedly being spanked, it's quite nice. This last week was phenomenal. So I'm going to keep this up until the market actually crashes, at which point I'll just be holding a bunch of puts, right? So
yeah, there's nothing wrong with making more money on calls than you do on puts. That's kind of the way it should work. But yeah, I definitely agree that the intraday pumps, like especially while things are still they still have a semblance of stability and nobody has their hair on fire yet. We're just going to continue to have these sort of pushes to reduce volatility, even to the downside. We're gonna, if we do have a red day like we did, we had a couple of red days last week, and then the market
I'll just sell ball right into it.
Well, I mean,
Exactly.
don't forget that, like, just like any other drop on any index ever historically, there is always short side capitulation. There's always an oversold rally. In every drop on SPX, you go back, unless it's an actual market crash, and even in market crashes, oversold rallies occur. Be prepared for them. If you suck at managing positions, buy some fucking, just buy a couple out of the money calls on the way down. What's the worst that happens while you're making money on your puts? Your puts are printing fat stacks. Pick up like, grab a fucking call slightly above me, just in case all the other put buyers decide to take profits. Then you don't get fucked, right?
Yeah, I think so. I think I've got a little bit of a sense. I've waded through some of the Twitter morons to try to get a sense of what the bull case is.
Okay, fill up our croissants. What do you got?
Here we go. So, speaking of filling up a croissant with a bull case, my son recently milked a cow at a farm.
Nice. Yeah, what was that like?
My wife went with him. I had to work, but she has a video of it, and she made me watch it. And I looked at my son. He's 7 years old, and I said, "Oh, that's cool, but you're not supposed to milk the male ones." And he didn't understand, and my wife just didn't appreciate it at all. And I just never felt so unseen in my life.
J Fresh, if you milk a bull, you make a friend for life.
Anyway, here's the bull thesis, and I'm not saying it's great. I'm not saying it's well thought out, but it essentially is this: bears have been crying wolf since the beginning of 2022. The market hasn't crashed. Inflation seems to be going down year over year. If I squint and don't pay too much attention, it's certainly going down a little bit, right? It's not at the top where it was in 2022. So that's improving. We're getting near the top of the Fed rates, so it's not going to get much worse than it's gotten. Everybody in the media is telling me that the bank crisis has been largely closed. That chapter is closed. The banks that were going to fail have failed. We contained it. Things are good. The borrowing windows are stable.
They're closing. The borrowing windows are closing.
Yeah, that's what I meant.
Okay.
They're not increasing, right? Which would be the bad thing, right?
Well, that's good for bulls, right? More borrowing, more liquidity, more push.
Well, yeah, okay, but I don't think they're
don't put that one in your bull theory. That's bearish.
That they don't need to rely on
striking it from the record.
Fine, stricken. Fine, I don't need it. You don't need anything to be a bull, but
that's already. I mean, just say it's greater fool and move on with your day.
No. So then, quarter one, sure, everything went down, right? But it all beat expectations, right? So it was only like negative 2.2.
Yeah, only down 30% year over year. So
well, in terms of like the S&P quarterly, it's like minus 2.3 or something like that versus the expected 5.7 decline. Everybody's still kind of, the forward guidance is muddy enough that, everyone's still expecting quarter 3 and 4 to magically turn around. And so things are looking up. Immaculate disinflation. So things weren't as bad as all of the naysayers said, and we're kind of getting through the worst of it. We're kind of at the top, and it seems like we're threading the needle. We're going to pump, right? We're not going to buy any stocks.
How do the bulls explain the prices being as high as they are? Like the prices we've already priced in all that. That's what we're trading at right now. We're trading at like these expected like high future valuations, right? So we're already trading at the top.
Well, we're trading at the top for tech companies, but
we're trading at the top for the S&P right now. I mean, even if you're considering like the positive quarter 3 and quarter 4,
right?
Are we?
I think so.
I think S&P is overweight. Take inflation off the forward PE, right?
Yeah,
Because
but
inflation's
again,
dropping. So now
you're
subtract
trying to argue with
8%.
you're trying to argue with someone that doesn't believe the thesis that he's laying out. I don't know how well I can argue on behalf of them, but that's what people are thinking, right? And that's all it takes for a lot of people to just keep the machine going,
Yeah,
right?
but
I
those
mean,
people
it's
don't fucking influence the markets, right? Who gives a shit what they do with their 401k every week? It's the same thing, right?
but I
It's
think
what's done with the margin from
a
their
lot of
401k that
financial, I mean,
matters.
a lot of financial managers. I mean, they're kind of the same way.
Yeah, well, that's
Yeah,
the
I think this
margin
is
from the 401ks, right? You put the money in, they buy safe assets, then they margin your assets in order to make risky bets.
Yeah, but they're gonna make those bets, right? So
Yeah,
don't be shocked this week if you
I'm
see
not.
upside. I'm
Oh,
talking
yeah.
to the people in the SPX
Oh.
channel.
Well, you know what it is? Everyone gets like entrenched in one direction and they like refuse, like almost like they're a shill if they buy, like I'm buying puts. Fuck those call buyers. Just buy calls too. Fuck everybody. Like just make money. If the market's rocketing up, buy a call, right? You know, that's
Yeah, we spew bear mayo all over this thing whenever we come on, but at the same time, on the same vein, that doesn't necessarily mean, we're just going out and levering directional bets, willy-nilly and saying the market's going to eventually agree with me. I mean, that's why you buy puts with theta and then you just make money somewhere else doing something else or just to the upside. Like,
yeah, don't get hung up on any ideology. It's still
Yeah,
a chaotic system.
I,
Like
I think if the
don't let your you know your overall macro analysis influence your zero DTE plays. I think
yeah,
is
I
a good
think
way to
in the
look at
short
it.
term, Monday, Tuesday, I think there's some upside there for. I mean, there's been more downside potential pretty much all year. And that's always true, but for the very short term, we've had sort of a bullish reversal on Friday in terms of options. A lot of that, yes, was zero DTE, but there's still some room historically on the upside for them to push back up to 4180 or so,
Yeah,
if not
tomorrow's tricky. Tomorrow we
tomorrow's
need to
really
see
tricky.
yeah, tomorrow we need to see either big call volume come in the morning and support Friday's move, or we don't see call volume come in and Friday's move collapses. And I think either way it's going to be pretty violent. So be prepared, buckle up.
Yeah, I would be prepared for either direction. Certainly, if you have upside risk, I
I'm
would hedge the
straddled.
upside risk. Yeah, I'm probably gonna pick up some calls in the morning just to protect some short stuff I have. But
I have pretty much no exposure right now. Unless SPY goes to 400 by Wednesday, yeah, I have nothing right now.
oh,
So,
dork, why didn't you? Anyway,
well, I sold the call at open because I was like, this might peter out, and then I held the put, and then that became a huge mistake as the day wore on. But I was also driving the whole day, so I kind of I wrote the put off as a loss, and the overall play was a loss, but it's only like a $60 to $80 loss from a $350 gain over the week. So like I'm fine.
yeah, you're good. Okay, that's good.
But
Look
I
at
do have to
you,
roll
risk
into something
management.
now. I think that it's a great time to move back into what I had, maybe with a little more theta. But I think Monday, the direction on Monday is going to tell me whether or not I should be more aggressive or just wait and just like get something with a little less theta, a little less risk. While I
Yeah,
was better position to open up where I can like roll my crappy put into a better put like I did last time, and it ended up paying off huge
Yeah.
because Vegas spiked on the 400, which was amazing. But that's kind of what I've been doing though. Is I take these positions, and it kind of comes along with my thinking on it. Is for me, especially with a smaller portfolio, I think of everything in terms of overall premium, right? So when especially when I have like an overarching thesis and all these things, and the market is still range bound, you think to yourself as you're I know it's a gamble. It seems like a gambler's fallacy, but it's kind of not if you manage it correctly with enough hedging and making money other places. But what I do is I increase my overall premium as the profitability goes down, and then I reduce my overall premium when profitability is up, right? So if I'm red, I'm like, averaging down or whatnot and kind of moving into more positions. But as I get more and more green, I change my positioning such that my overall risk to one direction is massively reduced. Like on Thursday, the market was down like crazy and everyone on CNBC was going nuts. And so I was like, you know what I'm going to do is I'm going to sell my put and then strangle 410 and 400 while SPY's at 405. And I did. And it kind of worked out. I could have made a bunch more money if I had held the position open over the weekend. I'd be $2 in the money. But at the same time, I didn't know what was going to happen overnight. I thought it might have even been bigger.
Compounding gains.
Yeah, and I want to polish this whole thing off with one last thing. If you're holding 40, 50, 60 DTE puts and the market moves against you in the near term, that does not invalidate your long-term thesis. You have a lot of time for for those contracts to go back up. And I know it hurts when you're like, VIX is crushing and the market's running 200 BPS. But just remember, we've still dropped more over the last 5 days than we've gone back up, right? Like overall net this week is down, and it's down like 100 BPS.
Doesn't feel like it. It's
it may not feel like it, but it is, right? And VIX is by nature volatile, right? And that VIX can move right back up to 20 where you bought your puts at the bottom of the run, and so not all is lost. Things can be averaged down. Sometimes you end up with a better position averaging down after something like this because you've gotten a cheaper opportunity. Maybe you bought your contract at a premium of 25, but now you can buy that same contract at a premium of 5, and the thesis remains valid.
Gets even stronger.
Yeah, and now you can your leverage is 4x, 5x on realization, right? So
enter slowly.
Take what the market gives you. Don't fucking pile into puts on a 300 basis point drop. I think is
speaking of shorting something that moves against you. I do want to make some notes about NVIDIA as well as we move into this week. It's kind of pushing its top of this current run, right? Still showing, upward movement. The delta neutral is still very choppy, but is still slightly pushing up over time. And so we don't see a reversal yet in the trend of any of the options. I did take a look at the forward-looking probabilities that the market maker is pricing in, and for most of this year, the max is where we're at now, 285 ish. But then the December leaps are showing a max of 300. So this guy might get his wedding. I don't know. I mean, I'm just saying, be prepared.
Yeah. What's the downside that they're pricing in?
The downside still hasn't really come up very much. It's still down at like 230, 220. It's just a matter of.
I mean, I could say something about NVIDIA over the last 3 weeks that I feel like people should know, or at least understand. On the upside moves in the early parts of the week, long sellers do not have faith in the current valuation of the company. Everyone thinks everyone's super bullish on NVIDIA, but they're selling Delta at alarming rates. And bear call spreads for credit on those upside moves are insane. I'm
selling a lot of deltas.
I mean, I am too, but it's not just me and you, right? The like every institution that owns NVIDIA is just selling calls anytime it moves up. And what's happening, why it runs back up to that range so quickly when it falls, is because they pull off their short calls, and then the price rockets back up again, and then they sell all their short calls again. And as long as they keep doing this, there's a ton of money to be made by being just out of the money on spreads. I mean, it's ridiculous. Like 50, 70% on risk for a weekly.
Yeah, I'm playing it much safer, but even like up at like 305, 310 in the short
Yeah, it's
term,
still like 25,
you can
30%.
make like 10 to 20% on your risk.
Yeah.
It's crazy.
Unlike and not on wide spreads either. These are like $250, $500 spreads. So it's you know,
Yeah.
bailed out most of my short position and is now paying for me to buy more short position. Which, you know, well, I'm fine with waiting for that to be realized. There's no question to me that NVIDIA is overvalued. They're not gonna, you know, grow at 500 times the rate they grew through the pandemic during the crypto bull run. So yeah, I'm not scared about NVIDIA's future valuations
Yeah.
exceeding
But I think it
anything.
will still, yeah, it'll still take a few quarters, I think, for all this AI shit to kind of work its way out in
I
terms
mean,
of like valuations. I mean, OpenAI is hemorrhaging money developing this stuff. I don't think they're
yeah, but
making
nobody's
something that
buying
anybody
more
really
NVIDIA
wants to
chips, right? Like
buy.
you
Right.
have all the hype you want, but
You need
they
demand.
raised their forward guidance by 8% for this quarter. They're gonna
What?
miss, right? Yeah. NVIDIA
I,
said
I
NVIDIA made
actually,
6
I
billion
actually
last
have
quarter. They
like,
said we're gonna make 6.5 this quarter.
I actually have malice towards the C-suite of
I don't see how
NVIDIA.
they pull it off. And you know, all the other tech companies, they waited till this quarter to raise their forward guidance. NVIDIA didn't. So NVIDIA already raised their forward guidance last quarter. And that, you know, now they've played that card.
Yeah.
So and like FSLR, if they've lied to their shareholders about their forward guidance potential, they're fucked. Everyone's gonna run for the door because they've been buying Nvidia at 150 fucking PE for 2 months.
Maybe.
Mm.
I guess some people have,
I
right?
know
Yeah.
they shut down production on the 4000 series cards a couple weeks ago. I assume they're trying to artificially inflate the market and reduce their inventory stockpile, but it's too little too late, right? That's 2 quarters of backed up inventory that they weren't even reported in the last earnings that they're now going to be sitting on that no one's fucking buying. Even if they were
Yeah.
buying them, they wouldn't be able to buy all of their fucking inventory because they have so fucking much.
Yeah. I'm
Like,
hopeful at this point.
has anybody seen an
So,
IPOs for like 5,000 AI companies in the last 3 months? Because I haven't. As a matter of fact, I
no.
haven't seen any fucking IPOs.
I have. Kenview
Oh,
is
shush!
a
Stop it.
spinoff. It's a spinoff of I forget who, Johnson and Johnson.
Did they buy $8 billion of Nvidia's inventory?
No, but
Ah,
they're
well,
gonna
that it
sell
doesn't matter.
Band-Aids.
Oh,
I mean, I
yeah.
kind of like it
Johnson
because
and
it's selling
Johnson's trying to
Band-Aids.
like split up so that it stop getting sued for giving
Yeah, exactly.
everyone cancer in the balls.
I'm down. I'm down for it. But yeah, you're right. I mean,
Yeah. So I think this is Bulls need to be patient and they need to.
Bears need to be patient.
Oh,
Bulls
sorry.
are
Yes.
impatient. Yeah.
Bears need to be patient here, and we know what the playbook is. Stop fighting it and start capitalizing on it. Right?
Yeah.
If they're going to be predictable, take some of their gain. Right? Take some of their spreads. Take some of their margin on their strategy instead of trying to fight them. Because I mean, if they've showed us anything, they are able to stop any sort of downward move, and they're doing it in a way that.
I
I
will
mean,
say
they're
their
just.
ability to do that is weakening.
It is
But
weakening, and I think some of that has to do with the margin pressures on what their capital is, and I think the DTCC is starting to tighten the screws on that and kind of say, hey, we're gonna start shutting this strategy down, but it's still gonna be here for a little bit until something breaks,
well, until
right?
they can
So
close those short puts, which is
yeah,
May 19th.
they'll roll them, right?
With what? They're you don't fucking roll short puts into a falling market. Not to mention, don't forget that the
The market's
downside
going up
risk. No, it's not.
this year. It is,
April was flat. April was the flattest.
but
April
I
was the
get that.
flattest 30-day period since like 2017 or
I
15.
don't see why they can't just roll it,
Because they're
unless the
not
market.
making any money. They're losing. It's a net loss. We already know this because of the tail risk
Selling
increase.
puts is the net loss.
The whole position, the selling puts and using 0 DTs to protect them, is the net loss.
Oh,
Because there's no gain. The market's flat. I mean, they're profitable on the 0 DTs on an intraday basis, but they're losing on the short puts over time. Every time, I mean, they just capitulated on half of their position on the downward push last week, more than half of their position, right? And now all they've got to lean on are the fucking no delta out of the money ones, which aren't protecting any of their downside, right?
Yeah, maybe. Yeah, I'm thinking more about all their no delta stuff that they're selling. I think those
Yeah.
they're just leaving there, and I think they're making money off of those.
But if the delta on those starts to go up, the market
Yeah, they're
maker's
screwed.
gonna slam the fucking entire index down into them. And then those are gonna accelerate downward price action. And if we get, I swear, if we get anywhere near 39.50, every fucking bear in the world is going to short the fuck out of everything to get the market under the JPM collar, just like we saw back in October.
Yeah, no,
Because there's
I'll be right there with them.
41,000 puts at 38.85. Long
Well,
puts, and everyone knows they're there, right? It's the biggest
we're just
telegraph
getting-
ever.
But I think that all of this is true, and I agree with all of this in general. However, I think what we're doing right now is just frothing up all of the bears in the chat.
Okay, all right. Then I'll say this:
they were thinking of hedging the upside, but now they're like, I'm going all in.
There are
September,
short puts at 4,100, and we can bounce off any price above 4,130. If we break down through 4,130 and we fall into the puts at 4,100, then that's some confirmation of downside. Until then, assume that upside volatility is very much on the table. Is that better?
I'm treating any soft downside above those points that you just discussed tomorrow as a good entry for the calls that will inevitably float us upwards.
Until they don't.
But yeah. So be
Yeah,
careful.
the market doesn't like to.
I mean, it's like my
slow bleed
positioning on NVIDIA is short strangling or selling fucking calendar short spreads on my puts and selling bear spreads at the top, right? I know eventually I'm going to get burned on that position, but when I do, I'll make a bunch of money off my long-term position. So even if you buy calls and you're long puts with theta and you're buying short dated calls, eventually you'll get burned on your calls. But when that happens, you'll make a shitload of money on your long dated puts.
Yeah.
Which isn't, that's not a bad place to be. Rex, thank you so much, man. I'm not going to play this song because I'll blow everyone's earballs up. But thank you, man. JPM collar in place to help with their First Republic bank obligations? No, it's part of a hedged equity fund strategy. It has nothing to do with fucking FRC. It was placed before FRC ever failed. Before they ever even gave FRC money, actually.
Who asked that? Well, who was
Stefan?
Of course, it's
Stefan. Yeah, he's
Ben,
really
come on.
He's gotten real deep into like the Euro-dollar conspiracy, and he's just been jelking himself to Euro-dollar university videos and crypto bro conspiracies.
The JPM collar is just a rolled position.
I hope we claw him back to the realm of logic. Yes, Stefan, the commercial real estate market is going to fail at some point. The
collars are,
but not for the reasons they're telling you.
Well, we've talked about the collar since well before the banks started failing. Why is it all of a sudden now to hedge FRC bullshit?
No, it's just a vanilla rolled.
In fact, I don't
vanilla position.
I mean, let's not call it vanilla. It heavily influences the levels we trade at on the SPX.
True. But it's not like a nefarious secret.
No, not at all. It's actually publicly disclosed and very obvious. Not only is the largest of those positions publicly disclosed, all three of them are. And it's part of what protects our upside is that equity fund 3. And I don't think that's another thing. I don't think they can prop the market long enough for the equity fund 3 to roll off at the end of May. So before the charm really starts to aid the upside, I think we'll be lower.
Gotta hope.
Not
but
ready for a charm bleed up. I mean,
uh,
everything feels like a charm bleed up lately, but
yeah, but it's
Well,
zero
it is on the
TC, right?
UDT side.
yeah.
Anyway,
I mean-
all right. Thank you guys
All right.
so much for coming on. I'm gonna try to actually close this down.
All right.
Dork,
Buy one
Fresh,
call.
appreciate it, guys.
Buy one call. Just try it.
With potassium like shares.
Have a good one,
Um,
everybody.
Yeah.
Thank you guys. Guys, everyone else, have a great rest of your weekend. Thanks for hanging out for so long. Pickles Picks will be out tonight, as I get them finalized, and I'll see you all tomorrow morning. Yeah, have a good one. If you have any questions, DM me later, guys.